Hello and welcome. You're watching India Market Open, and only if you thought that correction could extend into today, the good news is it's not going to. Global cues seem to be having a party. Record levels on Wall Street, Japan, and it all looks pretty good this morning. Good morning, Niraj.
Good morning, Samina. What Japan is doing is quite astounding, really. But yeah, as you said, it's not just Japan. Our markets, except for the corrective move yesterday.
Which was in order. It was par for the course. We've done really well for the last few days.
Yeah, so we have done well. US has done well. Nikkei is doing well. And every single point of time that people think that this will go higher, it came off yesterday. And then people thought, okay, this will correct itself more. And voila.
And I think what stood out, Niraj, was while at some point in the day the broader markets were sharply lower, the recovery was also worth making note of. So at midday, the broader markets had dipped 2%, but like you can see, they finally ended flat with a slight bit of a cut on the index, which just goes to show that the market still has an appetite for them to go higher. So when everyone's expecting correction, it's usually when it doesn't happen. But for now, everything looks stable. Implied Nifty indicating to a relatively good start this morning on back of a solid handover from Wall Street, and Asia as well doing quite well on back of that. Let's quickly take you through the global cues as we set you up for trade today. Weekly bank Nifty expiry is also behind us. Across Asia, it's a sea of green. Usually what we see is if China is doing well, the rest of Asia does lower. But today is an aberration where the whole Asian pack is actually trading firm. Japan is leading the way, up nearly 1%. Hong Kong is up 2%. China also trades with a gain of about 1%. Well, no particular reason that's driving Asian markets higher, apart from the fact that the handover from Wall Street has been pretty solid. Japan has crossed its psychologically important 42,000 mark, 42,200 now, almost 200 now, is what we have on the Japanese index. Overnight, Wall Street did quite well. The Dow, the Nasdaq, and the S&P came back with a bang. What led the markets higher is the fact that they believe that the Fed put is back at play. What the Fed put being back at play means that the Fed will rescue the economy if need arises. Inflation data is expected from the US later today. Economists believe that inflation should ease to levels of 3.1 versus 3.3 that was seen last year. Once again, reiterating that a rate cut could be around the corner in the month of September. But let's also be mindful about that, because from December last year, the markets have been expecting a rate cut. We've still not had it, but now, of course, the Fed bets are 75% believe that there will be a rate cut as early or as late as September or in the US. Well, it was chip stocks that did exceptionally well in US trade, and that's pretty much the sentiment across Asia as well. In Japan, what's leading the way up is chip makers. So that seems to be a big theme for global equity markets this morning. Apart from that, you have Citigroup that's in a little bit of trouble. Federal Reserve has fined them $60.6 million for violating a 2020 enforcement action. So that is, of course, retrospective in nature, but worth mentioning that that's a big hit coming in on Citi's books. That's what you have across equities. Crude as well doing okay. Crude prices are up about 1%, topping $82 a barrel. Remember, crude has been range-bound in that 82 on the downside to 90 on the upside in the last 6 months or so. U.S. inventories have declined for a change. Could be a seasonal impact on that. Also, OPEC has maintained that oil demand will grow 2.2 million barrels per day for 2024. So two positive triggers. A flat dollar is what's supporting crude prices in early trade. But all in all, Niraj, not much to report on globally except the fact that rate cut hopes are on. I mean, they never went off. And of course, inflation in the US should come slightly lower, but it seems like there is a good weekend party going on. If Thursday is your early weekend, then the markets there look very excited in Asia.
Yeah,
and I think not often do we see China going up with the rest of Asia. Today you have China, Hong Kong, Japan, South Korea. All those markets are doing well. So hopefully India is no aberration to that this morning.
Yeah, I mean, 45 points, so nothing dramatic for our markets. But let's see. I mean, if we have a Tuesday kind of a move wherein we start off okayish and then trend higher, it might be more than welcome as well. So the implied open not really stating dramatic. So, you know, I mean, that was the nature of the trade yesterday, right? There was profit booking seen, but as Samina said, at lower levels, we saw support. And if you look at the Nifty or the mid-cap index, the intraday, you will see It found support. It had 2 dips midway through trade as well, but ended almost at the high point of a 5-hour period of trade. We started off very high, then dipped, and then we ended at the day's highs, if you will, for the Nifty, for the mid caps as well. So therefore, in that sense, there was some bounce seen at lower levels. I think the issue is with specific pockets. So yesterday, autos dragged the indices lower, and you would argue that maybe the corrective move in four-wheelers at least may not be over. Remember, Volkswagen has cut the 2024 sales margin forecast on an EV plant closure in Brussels. Now, that may have an impact on some of the auto ancillaries with supply to Volkswagen, Samvardhana Motherson, for example. But autos may not necessarily be out of the cloud just as yet. There is a UBS note which says that how the pricing actions potentially point to demand moderation in premium SUVs, which is one of the fastest growing segments, and that other models might also see growth pressure driving discounting higher. So watch out for Nifty Auto. Remember, for all the fanfare around hybrids, Maruti ended in the red yesterday. So that's autos for you. And then cement expectations are rightly weak. This quarter is not expected to be ho-hum. I mean, great. It's expected to be ho-hum. And Kesoram numbers in kind of justify that. So whether, I mean, Kesoram has had a bad quarter now for a number of quarters. So it's not that Kesoram makes up for what cement is doing per se. But could there be pricing pressure, margin pressure, more importantly for cement names, is the key thing to watch out for in this quarter, and therefore maybe the numbers could be disappointing. So a number of sectors, Samina, have an issue, right? We know autos have had that. Yesterday, BofA downgraded, HDFC Bank, maybe presumably on the run-up done already. Axis Cap is downgraded, ICICI Bank. City Note today is a bit skittish on banks too. So banks have that issue. Yeah. Unless TCS delivers, and delivers massively, IT, which has already seen a bit of a run-up after Accenture.
But I think, Niraj, apart from earnings, what I think is driving tech stocks were not gaining because they were expected to report a good quarter. They were gaining on expectation of a rate cut coming in from the US. So if Wall Street does well, what usually stands out is you see tech as a space in India do well. I mean, I'm just trying to look at the glass slightly differently from what you are this morning, because I don't think anybody is expecting green shoots, recovery, while we keep talking about it and hope that that comes our way. It seems like until the elections in the US are behind us, there isn't going to be meaningful, significant recovery in the US for tech companies.
Save for one thing, that can Indian IT do what Accenture did in terms of generative AI deals? Because that might just be the music.
Well, we'll have to wait and watch. But pharma did okay in trade yesterday, and so did FMCG. So defensive could be coming back at play. So it's sector rotation, right? While Niraj highlighted how stocks have been downgraded, you had an upgrade coming in on Maruti by Morgan Stanley 2 days ago. So they expect an upside there. Of course, the stocks haven't reflected that. But I think the story right now is got very little to do with fundamentals. It's pretty much where the money is going. And we saw stocks like an RV, and it'll still do well in trade, despite the fact that everyone is indicating that these look like very expensive stocks. But these counters have performed, and they continue to generate investor wealth. Talking about the markets, quick data points as well. Maximum call OI continues to be seen at levels of 24,500. So it's moved actually from 25,000 that we saw a few days ago to 24,500. On Monday this week, it was at 25,000, now at 24,500, meaning that the markets will face stiff resistance at those levels. On the downside, support continues to remain at 24,000. That's where we've seen maximum put OI as well. Another standout was the VIX has continued to rise for 3 straight days, now making it slightly uncomfortable for the bulls. This, of course, is what happened in trade yesterday. The PCR, which is a put-call ratio, was also below 1% in trade. Usually a higher PCR, which is above levels of 1%, indicates that the bulls are in control of the trade. Going below 1% only means the bulls could be losing some control of these trade. But for now, fortunately, we've opened up to strong global cues. We will take a little bit of that from that in opening trade. And of course, what's going to be important is if follow-on buying comes through, which was obvious when the broader markets recovered in trade yesterday. But earnings season is upon us. We have a bunch of companies that reported in trade after markets closed yesterday. Niraj started talking about how tech and all eyes will be on TCS tomorrow, but Tata Elxsi reported numbers. Wasn't a great quarter from what I see. Of course, we'll try and analyze it with an analyst shortly. On the face of it, revenues have gone up Revenues are also down. EBITDA has been hit and profits are down 6.5%. Margins have also declined substantially. Margins have also come in at 24.3 versus 25.8. So that's a pretty significant decline. So while they've managed to do okay on top line, margins and profitability have taken a hit. What you want to keep in mind is this is also below what the street was expecting. So Bloomberg estimates were slightly better than what those numbers are. Stock could be seeing a negative reaction in early trade this morning. Apart from that, you had Kesoram Industries, smaller company, but again, very disappointing quarter for them too. The revenues were down 12%. EBITDA was down a whopping 33%. Margins have also declined 300 bips, coming in at 7.9 versus 10.5. And they've posted a loss of 62 crores versus a loss of 32 crores that was seen in the same quarter last year. So weak, all the way weak for Kesoram Industries. Clearly no sort of worth on the counter in terms of a positive up move. It is going to be a bad day for Kesoram as well. What came in as a surprise is discretionary spending from the look of it. Sula Vineyards reported its best quarter ever. Revenues did quite well. In fact, net revenues came in at 130 crores versus up 9.7%. Why? This comes in despite the fact that wine tourism was actually down 2.5% year on year. Their own brand revenues also seen an improvement, so up about 2.7% to come in at 104. Management seems quite optimistic. They said that the tourism sector did face challenges on back of Lok Sabha elections, dry days and heat waves, but despite that, they've actually managed to have a pretty good run. The stock has not done too much in the last 1 month. It's down 3.5%, but I'm guessing a good set of earnings could actually give some support to Sula Vineyards from here on.
Yeah, so certainly watch out for that. To my mind, the first stock on my radar is Yes Bank, with this Moody's upgrading Yes Bank outlook to a positive and affirming the rating. Moody's has said that the outlook change reflects our expectation that a gradual improvement in Yes Bank's depositor base and lending franchise will help improve its core profitability over the next 12 to 18 months. For a stock which hasn't quite gone everywhere, last 1 month 5%, yes, but otherwise it's been steady. Today might be a big day of a fillip for Yes Bank. So watch out for Yes Bank in the session today for sure. Then watch out for the Q1 update of, rather the operational update, toll update of IRB. That seemed interesting because June, they have seen a growth of about 35% as IRB. So therefore, that's a stock that you certainly want to watch out for in the session today. Keep an eye out for IRB Infra. May see a bit of an uptick, maybe. And then there is Glenmark Pharmaceuticals and Glenmark Life. So Glenmark Pharma, because they've approved selling this 7.84% stake in Glenmark Life through an offer for sale route. The share, the floor price is 810 rupees per share, which represents a 7.5% discount to current market price. Now, this is important for both the stocks. For Glenmark Life, the last of the stake sales overhangs from Glenmark Pharma with this stake sale. So if it gets absorbed well, there might be a bit of an uptick for Glenmark Life. And for Glenmark Pharma, because they are the ones which are selling, they get some more monies, and therefore it might be positive for Glenmark Pharma as well. So that stock should be watched out for. These are the first three on my radar, Samina.
Very quickly, Niraj, on the Glenmark stakes, it is Glenn Saldana who's also offloading. So this is going along with all those promoters, of course, who are offloading as little or as much as they can. But remember, in March this year, Glenn Saldana announced his resignation as a chairman. So that could be on foot of that. A few of the companies that could see some movement on back of news is you've got Power Grid. So watch out for Power Grid in trade today. They've announced borrowing funds of up to 16,000 crores during FY25 and 26 through domestic bonds. These, of course, will be your typical secured, unsecured, non-convertible, redeemable, taxable or tax-free bonds under private placement. So Power Grid could be one that's talking about fundraising plans. You also have some good news flowing in for Zydus Life Sciences. The company and its subsidiaries have received a final approval from the US FDA to market a drug. This combination drug is what treats chronic heart failure in adults, reducing the risk of death and hospitalization. We will get a sense of what the market size of this drug is, but on the face of it, it looks like this could be the last leg in approvals and the drug coming into the market. Apart from that, Niraj, anything else that stands out for you? I think there's some other ones in terms of SBI and Mason Valves as well.
Yeah, no, some brokerage notes seemed interesting, Samina. So 2 or 3. One of them is this Macquarie note on Asian Paints, and why this becomes important today is because yesterday the paint stocks were on a frenzy. Look at what yesterday, for example, look at what Asian Paints, Berger, Kansai Nerolac and Indigo Paints, more importantly, did in trade. All of them are up and about because of a 1% price hike. Yesterday, in fact, was a day of price hikes and price cuts, right? Price hikes by paint companies, they did well. Potential price cut by SUV companies, those really fared badly. Term insurance premiums may be hiked, so insurance stocks did well. But the reason why the Macquarie note on Asian Paints is important because they are saying, amongst other things, the outperform rating target price of 3,800, which is a very stiff price target, by the way, compared to the current market price. But they are saying that the marginal price hike is a possible indicator of comfort on demand trends. And they say that the 1Q demand trends, according to Macquarie, are slightly ahead of those seen in Q4. Now, is this therefore a positive until the results come out and we hear from the managements? Remains to be seen, because this price hike means that they will talk about better operational metrics for Q2 since the hike has been taken just now, after Q1 numbers are over. So therefore, it could be very interesting to look at paint companies today.
Just that there could be a crude uptick and hence maybe a little bit of softness.
So maybe this price hike
it was need of the hour.
Yeah.
Just a small company, 3,500 crore market cap, but JTL reported numbers as well. Now the stock has been a huge disappointment, unfortunately. Year to date, the performance has been dismal, but their numbers were pretty good. So they reported a 21% rise in net profit at about 31 crores. Which was aided by higher revenues. Revenues have also seen a rise. Profits came in much better than what the street was expecting. So if you're hoping for a relief on the stock on back of earnings, this could be it for GTL after it's actually sold off nearly 8% year to date.
Yeah, and the other brokerage note that I wanted to highlight was the Nomura note on Ambuja Cement. Now, standard disclosures, of course, Adani Group owns Ambuja Cements and Adani Group owns NDTV, and you're watching this on NDTV Profit. But Nomura has upgraded the stock, double upgrade from a reduce to a buy. The target price has been raised from 500 to 780. Effectively, they are saying this above the capacity expansion that they are Ambuja is on will lead to above industry volume growth. More importantly, their FY24 to 26 volume and EBITDA CAGR of 13 and 28% is above Ultratech's CAGR that Nomura estimates as well. So watch out if Ambuja Cement reacts today. It could be on the back of this brokerage note. And then there are others. I think Citi is this note on Jubilant Food when they have a stiff price target hike as well. There is, I think, a Nuvama or an Axis Capital note on Anup Engineering, 16%
They've kept
upside.
Themselves very busy, these brokerages.
Yeah. But it's pretty interesting. Some
and all
of
that
these
rolling
brokerage
out just
notes
ahead
well.
of earnings season. But I think the caution remains on the street. I think there was an article this morning as well where MNCs are selling. It seems like there could be trouble, but then I don't know who's to tell, Niraj, because we've been, and in fact, Sajid, we were discussing this. Advisors have been recommending sitting on cash all the way back in October. Markets, of course, have gone up 25% since then, so let's not take that too seriously. Not much has changed. Recommendations are still coming in. Sit on cash. STP should be done over a 6-month period versus a 16-week period. But I believe we've got more on that with Sajid, where you all are going to be discussing where the money is going and whether or not we're topping out anytime soon.
Or how much money is coming as well, because
and
that's
where
not
is
that
it coming from? But one thing is the debt markets haven't picked up too much, so maybe the FI is just choosing to sit with equity markets, and the support that we didn't get is finally coming in from them, even if retailers are selling.
Maybe. Alex, what's the crux of the topic today?
Let me set it up for you. And in fact, if anybody's tuning in for the first time, this is Editor's Cut, where we go beyond the headlines and we get you the story behind the numbers. And it's an interesting set of numbers that we're talking about today. We're talking about retail flows and what they're indicating. There are murmurs to suggest that there could be tweaks in the regulations that govern trading activity, and we'll have to see what direction that takes. But those murmurs are suggesting that retail participation could in fact be affected by that. But the numbers that we've seen in the financial year so far seem to suggest that that's far from anybody's mind. And Sajid is going to break that down. And we're also going to talk about primary market action because, boy, look at the numbers there. Niraj is going to talk about some of that. But let's first talk about retail participation. Is there anything to suggest that we're peaking?
Let me start with the number first. In the first quarter of FY25, means April to June quarter, we saw retail investors investing net in mutual funds of nearly 94,000 odd crores. And that compares to 1.8 trillion which was there in FY24. So half of last year's net inflows have come in the first
quarter.
One quarter. Now, is that an aberration? My view is that it is an aberration because we had a June event which came in with respect to elections, and it was a huge volatility, and retail may have participated in big amount, and that's why we saw 40,000 crores coming in June alone, while the average has been 20 to 22,000 crores every month.
Yeah.
So it's a double the
and
amount.
40,000 only in actively managed funds.
Actively managed funds. So that, and equity funds basically.
Yeah.
So that's something which is coming in there. Look at how individuals have been doing in the first 2 months of this financial year. In the cash market, we had really 24,000 odd crores of net buying which happened, and this compares to nearly 47,000 crores happening in FY24. So again, there's a huge amount of retail activity there. If you look at individuals' market share in the cash market, that's gone up to 35% now, which basically means that DIs and FIs share have shrunk a lot, and a lot of retail money is chasing there. In the equity derivative market, a fourth of the market is now retail investors or investors which are doing small trades and other stuff, and that's also worrying.
It's gone up from what, Sajid, approximately?
It was in single digits few years back to 25. If you look at SEBI came out with some numbers maybe a couple of weeks back, and they said that in 2018-19 it was around 9 odd percent, which has gone up to 40 odd percent in some categories, right? So that is also something which is there. So where are we going from here, and how retail is going to impact the stock markets? The big question is that my sense is that inflows are going to cool down a bit, not only just into mutual funds, but also into the capital markets as well.
But why?
In the cash and two things. In the mutual funds, the level of cash which has been held by many of the schemes are increasing. There was a time when we used to stare at mutual funds when they used to hold 2 to 3% in cash. Now it's 5 to 10% in many of the schemes. Many of the schemes which are now being launched are not sustainable. Within a month, they are closing down because they can't handle the money.
Yeah.
So, how are you bringing that money, and where are you deploying? If you are not able to deploy, that means there is an issue.
I do want to put a caveat, though. The schemes that are closing, and Niraj can weigh in on this as well, thematic and sectoral funds.
Exactly. But then they are not sustainable.
So depth is not there, right?
Yeah.
But the broader markets, they're not. In fact, if anything, you recently saw a Kotak small cap fund opening up for subscription once again.
True, but at small cap funds, we have seen small cap and mid cap funds also closing down for or getting restricted flows because they're not able to do it.
No, that's a fact. Yeah.
Simple as that.
Playing the devil's advocate, if you take a 5-year view, right, we've seen instances of people saying demand has peaked, numbers have peaked, funds are closing down, people are being cautious, and over a 5-year period, we are at a number, or the number 5 years ago is a fraction, literally a fraction of what the number is now currently. So who is to say whether this is the peak?
No, I'm not saying this is a peak. I'm saying that is there a runway ahead, or there's a pause ahead? That's the question that I'm asking.
I mean, the numbers right now in quarter one, as Sajid says, to my mind, point to that has a deluge come in and maybe it will trickle down.
Yeah.
But could it be a factor of what the markets do?
Because the retail is not getting the returns of that, right? If you're going to park the money into cash, in mutual fund, if you're putting your money and the money goes into cash, you're not getting an NAV return here.
But the rest of the portfolio is doing incredibly well.
Is doing well. You're getting better than FD rates.
Much better than FD rates.
Could be. I'm not saying that.
And the other aspect
is that.
And by the way, sorry to debate that point once again. It's only a few funds which have taken these large cash calls, not everybody.
Across the board, every large mutual fund...
3 to 4%.
More than
it's
that.
It's only Paramparikh, etc., which are at 10%.
No.
Correct.
But Most of them are at average 5%.
But having said that, one last point that I will mention, and I know that we debate this in the newsroom on an ongoing basis, but every month since the month of July last year, you've had a new gross SIP flow. And I'm saying this very specifically because I know Sajid is going to try and counter me on this. Look at the net number, yeah. Right? He's going to say, look at the net number. But we've had conversations. Let me complete this statement. We've had conversations in the past with veterans of the industry that have pointed out that when SIP flows were 12,000 crore on a gross basis, even then it was 50 to 40%, 40 to 50% was the net number. So that net number itself has doubled or practically doubled, which means that there is still a deluge of money, much more than what was coming in earlier.
Let me come back to you on that one. If you speak to veterans in private, they will tell you that there's a huge redemption happening through SIPs, and the net SIP numbers are much lower than what is been projected by AMFI, and AMFI has been very
cagey about it.
Cagey, and they're not being fair and transparent in the way the numbers.
That I will agree with, because we asked repeatedly.
We have been asking repeatedly for last 2 years of data on net SIP flows, and AMFI is saying they don't have it.
While they don't compute it.
No, they don't have it.
They said that they don't compute it.
But the same numbers are provided to all the AMCs on a monthly basis.
So that's something to take up with them separately.
But my point being here that retail flows, retail is getting targeted. Not only from a regulatory but also from a policy point of view. Your margining system is getting tightening for them. You have make direct margins, so leverage is getting reduced in the cash market for them. And going forward, F&O market leverage is also going to be hit, and so there would be a reduced participation of retail. This 25% share in F&O, 35% share in cash market is becoming a little bit of worry for the policy people. Simple.
Can I just add my final point on this before I get to my topic very quickly, and I'll make that quick. If anything, if all of this happens, it will actually turn out to be a blessing for the mutual fund industry, because people will realize that they can't participate so much in F&O, etc. Let's go down the mutual fund route. So all I'm saying is, for the last 5 years, we've heard comments about how the numbers are looking like peaking out. We are much higher than what we were. How high can we go? And we've gone higher. So I've stopped preempting what the number could be like.
Very true.
You look at global examples.
I thought so.
You look at global examples. These trends don't get over in 5 years.
Absolutely.
They last for 20 years.
Let's put a pause on this this particular conversation, because we can go on with this. There's one more point that we need to talk about, and that is the primary market, because that is back with a bang. Niraj.
So, Alex, actually, not just primary market. The reason why I thought this makes an addition very well to what Sajid was trying to say is that if there is a substantial demand, that is necessary because the quantum of supply is literally a deluge. And look at the numbers. I have borrowed it from the Access AMC note that was written. They're saying the quantum of IPOs over the next quarter is 3x the IPOs in Q1. So therefore, the quantum of primary market supply, paper supply, immediately in quarter 2 is very high. That's part one. The IPO pipeline over the next few months is over 90,000 crore rupees.
Yes.
Forget the nature of the IPOs, that it is not being used for capex, it's being used for promoter. That is a separate argument. But the paper is coming to the market. So that's a large quantum of paper coming to the market. It needs demand. Part 2. And it's necessary, by the way, for the paper to come in, because the market needs to broaden out by virtue of the supply that is coming in. Otherwise, the expensive stocks become more expensive. But it's not just the primary market paper. The PE stakes in public companies is substantially higher. At some point of time, all of this will come. Access note suggests that it is over 2 lakh crores. This is a large quantum of paper coming and hitting the markets over the next 9 to 12 to 15 odd months. We better have the participation that we have currently, or else we are looking at a corrective move in the secondary markets to account for the money that is being raised through the primary market.
Just to add to you, 90,000 crores coming in, 45,000 crores have to come from HNIs and retail from them. So that's the kind of liquidity that is required from the retail. And when you talk about 2 lakh crores of private equity holdings which is there, and they have to come into market because they have to exit, that will entirely go to DIs and FIs because they come through block deals.
Yeah, that's a fair, and which is why we've already been seeing so many block deals. Anyway, it's been a fascinating conversation. I don't think that we have a conclusion, though. Some of us have made some conclusions, but maybe you had a few questions about retail participation, and this has helped you along. Let us know what you think about the conversation that we've just had. We've got lots to talk about before the start of trade, particularly to do with F&O, because it is, of course, options expiry day. Do stay tuned. Lots more coming up.
Welcome back. This is India Market Open. Let's take a look at how things have fared yesterday in the futures and options space. We start by taking a look at the Nifty, which was marginally in the red yesterday. And along with that, we saw unwinding as far as the July futures are concerned, with an open interest declining by as much as to nearly 3%. It was, more or less a case for the Bank Nifty as well, considering the kind of traction that we've seen here, down by around 0.7%, losing out on the 52,200 mark. And along with that, a near 9% decline in open interest as far as the July futures are concerned. So we have seen unwinding in both these key indices going in. Today, of course, is the weekly options expiry for the Nifty. We're keeping an eye on 24,000, but besides that, 24,200 and 300 levels as well, because that's where we've seen a reasonable amount of put open interest distribution increase. And of course, on the higher end, considering the Nifty moved lower yesterday, a lot of traders took that as an opportunity to go and sell calls around the mark of 24,500 and 24,600. We likely could see a little bit of resistance in today's day of trade. Of course, notwithstanding that, should we see a sharp open and see the Nifty climb higher and perhaps sustain above the mark of 24,400, 24,500, then of course we start seeing covering of these shorts of these calls, and that could potentially propel the Nifty even higher. But that's a wait and watch. These are just scenarios, various scenarios that can potentially play out today. Now, as far as stocks are concerned, yesterday was a mixed day of trade, but more declines than advances coming through. It wasn't any different in the stock future space either. We did see shorts for M&M, perhaps the biggest mover in the day yesterday. And Hindustan Copper, Shriram Finance and Tata Steel also looking at shorts building in. Among stocks which saw unwinding, we had about a short covering for something like a Bata, Balrampur Chini, JK Cement, long unwinding for Chambal Fertilizer and IEX. Chambal Fertilizers has been an extremely volatile stock of late, and it did in fact at one point in time test levels of below 500 rupees per share, so that's another one that we can watch out for. IEX was an interesting one because we've recently had a handful of buy calls from a few technical analysts, but yesterday was a day where we in fact saw it come off by around 4%. In any case, the question really is that with all that has happened at the moment and the kind of consolidation that we've seen over the past few weeks on the benchmark indices, what are we doing with this? Well, let's get in an opinion here. We have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Let's just start off with your view on the benchmarks in general. How are you expecting these to play out when it comes to the Nifty and the Bank Nifty?
Good morning and thank you for having me. Continuing from last week where the position was that there will be a mild move on the upside and the upside will be very limited. So from last week, you will see Nifty is not moved much on the upside. And that is why the kind of structure we created last week was taking that into consideration. Our view holds status quo. We don't expect Nifty to move sharply on the upside from here. In fact, we see a cap somewhere around 24,500, 24,600 on the upside. But the downside is open. What do I mean by the downside is open? If you see 24,000 breaking with a good, nice red candle, that is an elongated red candle or a filled red candle where the wick is small and the base is big, we expect to see another 400-500 points on the downside to 23,500. So that is something to keep a watch for. So on the downside, you have about 700-800 points. On the upside, you only have about 200-300 points. So purely from a risk to reward perspective, we don't suggest going long at this point in time.
I want to remind our investors and traders that 24,000 over the last few days has actually seen a lot of traction when it comes to support. Now, you actually do have a lot of analysts who suggest that 24,000 at the moment is going to be a tough level to take out. And as Rahul is mentioning, if we in fact do see market participants take out that 24,000 mark on the lower end, well, there could be a little bit more pain which is in store. But based on that, Rahul, I believe that at the moment you are looking at a little bit more bearishness when it comes to the Bank Nifty relative to the Nifty.
Yeah, that's absolutely right. So it's very possible Nifty stays a little choppy till the budget. And July series ends right after the budget. So when we are planning a trade, expecting a little bit of correction, not something big bang, we want to take the August series into consideration and not July series into consideration. Also, we expect IVs to further rise a little bit because of the budget expectation. You notice IV has been rising for the past 4-5 days. And even though Nifty's had no big bang movement, you still see IV going up about 10% or slightly more than that in the last couple of days. Keeping all these views and factors in mind, what we're doing is we're buying the 51,000 put in Bank Nifty. Now, why Bank Nifty? Firstly, Bank Nifty is the weaker index if you've been keeping track of both the indexes for the last couple of weeks. So we're buying the 51,000 put of August end expiry. Now, keep a note that we need to enter this position once Bank Nifty crosses 52,300. I reckon that should happen this morning as Nifty is opening with a small gap up of 30-40 points. It's only about 120 points away. So above 52,300, you go ahead and buy the 51,000 put of August end expiry. and you sell the 51,500 of July end or July 31st expiry. The premium credit that you get, on the 51,000, you should be having about 590 rupees in debit. On the 50,500, you should be having about 210 rupees in debit. Now, the way this structure is formed is so that in case Bank Nifty stays sideways or Bank Nifty goes down, you tend to profit. Where will this structure lose us money? If Bank Nifty moves up sharply. So in that case, what we're going to do is, if you notice, the offset unit or the hedge used in this particular trade is 50,500, which is the first week of August, or I beg your pardon, the last week of July expiry. You still have a couple of weeks expiry after that. So we're going to keep selling the 50,500 in August as well in every weekly expiry to get back some debit. This makes the strategy lower in risk if markets go up sharply and does not play as per our view. And if market plays as per our view, from sheer capital employed to return perspective, it provides to be very handsome. If I'm not mistaken, the capital required for this trade should be approximately about 20,000 rupees, and you stand a chance to make about 3,000 rupees in about a month and a half towards the maximum.
Right. Rahul, it looks like a bear spread, but it isn't, right? Because you're actually using two different strikes across two different, expiries. My question then is, why is it that you're doing? And I believe that the scope of you making a larger amount of money in a relatively longer dated expiry is a lot more, and is that why you've chosen to buy the August expiry, and and against that you're choosing to sell the July expiry?
You're bang on right, Adam. Both points are correct. Firstly, the reason we're taking an August expiry and not a July expiry is because we are expecting IVs to rise for budget. Now, IVs normally have higher impact on closer by expiries, but in this particular case, because the expiry is only 2 days after the budget opening, it's preferred to take the August expiry, which will have an equally good impact once IV rises. Also, it gives us more time for Bank Nifty to go towards the downside. That is point number one. Point number two, if we actually sold 50,500 of August end, my risk in the trade would reduce. But the problem with doing that is, in case Bank Nifty goes down, my profit would hardly be about 600, 700, 800 rupees, which is not very interesting, keeping in mind that we have a month and a half left. That is why we're using the weekly expiry. In case Bank Nifty moves down slowly, which is what we expect, the 51,000 would make us money and the 5,500 would expire worthless. So both can act as profit-making units for us in case the view plays out well. That's another reason why we're doing it this way. So to answer your question in short, yes, it is a calendar bear put and not a vanilla bear put.
All right. Well, fair enough, Rahul. Point taken. Thank you so much for explaining and taking us through that option structure, and very interesting one at that. We'll continue to give you an update on this one as well as we talk to Rahul next week, same time. But that's the view on the Bank Nifty, the call on the Bank Nifty, and with that, it's over to you all.
I'll take a moment to thank you, Agam, for the F&O update in trade today. Well, that's, of course, the strategies that we're expecting. But let's quickly go over to Varsha. She's got a whole list of stocks that we should be tracking this morning. Varsha, it's over to you.
Good morning, Samina. So, let's start with Glenmark Pharmaceuticals, wherein they have approved sale of 7.8% stake in the Glenmark Life Sciences through an offer for sale. Floor price is set at 810 per share, which represents 7.5% discount to current market price. And Kotak Securities Limited is to be the broker for the OFS. Remember that this year in May, Nirma completed the acquisition of 75% stake in Glenmark Life Sciences. Now, if you see the shareholding pattern as of March 24, Glenmark Pharma holds 7.8%, while Nirma holds 75%. So Glenmark Pharma will be out of the Glenmark Life Sciences totally. Then we we have Shalby, wherein they've received a Mumbai Charity Commissioner's note for executing 30-year lease for Asha Bharek Hospital in Mumbai. Period of lease is 30 years, and they're gonna construct a new 175-bedded healthcare facility. Then we have Oriana Power, wherein they've received new order of rupees 155 crore for 40 megawatt solar plant in Rajasthan, and this contract need to be executed within 9 months. Then we have Bajaj Healthcare, wherein they've approved raising of rupees 206 crore via equity shares to non-promoter of rupees 137 crore and warrants to promoter of rupees 70 crore. And lastly, we have PTC Industries, wherein company is gonna conduct a board meeting on July 13, where they're gonna approve fundraising plan for the same.
Well, certainly watch out for some of these. PTC Industries, Varsha, thanks for that, has been a rank outperformer. Their business plans, from the looks of it, from reports that I have read, very ambitious, fundraising happening, could be interesting to see. Glenmark Life becoming very interesting, and a few others too. Pfizer could be Zydus rather could be in focus because of that cancer drug piece as well. So lots of important ones to monitor today, including autos and including IT, ahead of the TCS numbers. Avinash Gorakshekar, Director of Research at Profit Mart Securities Johnson, right now on the show on the fundamentals. Avinash, great having you. Thanks for taking the time out. Avinash, let's start off with yesterday's top newsmaker and what to do there or how to think about it, which is autos. The corrective move that came into Mahindra and Mahindra because of that price gash that we saw, the price cut that they've taken in select models. Can it spread far and wide? Brokerages are of the opinion that other models could follow suit. And is all of that priced in already, or do you reckon there is chance of a further downside in four-wheeler stocks?
Yeah, good morning, Niraj. See, I think one thing which we need to understand, Niraj, is in the last 2 years, the auto market was largely a supply-driven market. There was a huge supply crunch of the top-end models from Mahindra, from Maruti, and that was the reason, car manufacturers, specifically, vehicle manufacturers which were running a large order backlog were actually commanding a premium on their vehicle prices. But I think now what has happened is that production capacities across companies have gone up, production levels have gone up, and now demand is, the entire car market is driven purely by actual demand. And therefore, these premiums are now, going to vanish. That is the reason, Mahindra and Mahindra took a price cut. I think we could see this happening for some of the other models also. And I think it's not a surprising fact, considering the fact that most of the auto companies prefer to keep their vehicle prices pretty attractive, because that's how the volume growth actually kicks in for these vehicles. What happened in the last 2 years, typically, Niraj, was something of an aberration. I think it won't continue in future. So I think your point whether, this will continue for some more time, yes, it will continue. And we'll have to see normal, realistic demand levels now coming in, because what was happening in the last 2 years was supply-driven demand. And that was the reason, these companies were making better than expected margin. So definitely there could be a little bit of margin crunch. At the same time, I think now the entire focus of the car, vehicle companies would be to focus on pure volume growth, because if that continues, which I think has not yet been badly impacted, we could see normal growth. But the markets would definitely be a little disappointed, because whenever the companies cut down prices, that means a little bit of ease on their pricing power. So I think all said and done, Mahindra, Tata Motors, Maruti, my guess is that, you could see a little tepid numbers from the July to September quarter, considering the fact that price cuts now could be a little more active and little more significant compared to what we have seen in the last, say, 12 months. So I think net, it's good longer term, but in the short term, I think stock prices would continue to remain slightly under pressure.
Right, that's the call coming in on some of these auto stocks. Shrikant Chauhan as well joins in with a technical view on the markets. Hi Shrikant, good morning. Thanks for joining in. How do you feel about the markets this morning? There was a little bit of a correction in trade yesterday, some profit taking. But of course, even the weakness across the broader markets got bought into towards close. Are you constructive on the markets this morning or circumspect?
Good morning, Samina. Good morning, everyone. I think it was much awaited correction, because the market was just completely overextended in the short term. We saw the levels of 24,300 and 500 in a very short span of time, the overall formation of the market is suggesting us that it is going to consolidate. So we are like still constructive on the market. We are not expecting any major crash in the market. But yes, there could be some correction because the overall over retracement in the market. And on the downside, I think 24,000, 23,900 is going to act as major support in the near term, where the market is having support of 20 days simple moving average. So in case if we see any correction in the market, I think close to this 23,900, we are going to see a good amount of buying support. But at the same time, at higher levels, we are advising our clients to reduce some long positions or to consolidate the portfolio, because broadly we are at extreme levels, and technically also the market is very close to all important resistance levels. Also, if we go through with the option statistics, there also we can see very clearly that there is huge amount of call writing is lined up close to 24,500. So it is going to consolidate that's the overall view, and we could see some stock specific activity in the market.
Shrikant, talking about stocks, is there anything that you're recommending this morning? So what are your top stock recommendations?
Yeah, I think all these oil and gas stocks, they are showing a lot of strength because of specific, like there is buying interest in almost all the companies. If we go through with stock like Castrol, then it is very close to its all-time highs. But at the same time, if we see the long-term chart, then it is indicating us that it is going to surpass its crucial major barrier of 255, 260 in the near term. And in that case, we could see the levels of maybe 275. So it's a buy at current levels around 250, 252 with a stop loss at 240. It is into long-term breakout, so it's a buy at current level. Also, we like GAIL, Gas Authority, and there also we saw a smart recovery from lower levels. It was around 220.21 during the day. From there, all the way it closed at 230. So from here, again, the stock can move towards the levels of 250, 255. So it is relatively better as compared to other oil and gas companies. It's a buy at current level with a stop loss close to 220.
Right. Those are a few buy calls coming in from, of course, the oil and gas pack, which looks a lot more constructive than maybe the rest of the market. Avinash, how do you feel about the oil and gas stocks? There has been reason for movement there, but fundamentally these counters are looking good for a buy at these levels.
Yeah, I think if you look at the oil marketing space, we continue to be positive on this segment, considering the fact that, crude prices have remained benign and fairly stable for a long time. And unless there are, other kind of geopolitical kind of issues, I think the outlook for crude oil price looks to be pretty stable. And, if that happens, then I think companies within the oil marketing space like HP, BP, definitely, could definitely be considered as a good investment, considering that, two key sectors, automobile and aviation, have been showing pretty strong volume throughput growth. So this is definitely going to benefit them. Another, energy sector where we are positive is the gas sector. I think of late there has been a lot of action on the gas companies. So I think companies like Gujarat Gas, Indraprastha, Gujarat Gas, MGL, one could also look at these companies, considering that there are expectations that in the coming budget, some duty structure alignment could happen. And I think, government is also focusing on clean, fuels. So that also goes a long way in ensuring that, companies which are into the CNG and PNG segments would definitely also benefit. So I think these could be opportunities in this kind of volatile market, for a medium to longer term kind of time frame.
Right. Well, that's a few of the oil and gas names that are in focus, a technical and a fundamental view coming in. Well, let's also put the focus on a brokerage report that's coming in. In fact, Citi has put out a brokerage call on Jubilant Foods. Anushi is joining us with more on that. Anushi, this morning is all about brokerage reports, at least in terms of stocks and news. You want to take us what Citi has to say about Jubilant?
Absolutely, Samina. So as you mentioned, now Jubilant is in focus ahead of Citi's note, and they've raised they have their target price set at about 663, which is a 14% upside. So this is on the back of a couple of factors that we are looking at. First is, if you have to look at its valuation, they've raised their valuation multiple, EV/EBITDA multiple, to 36 times as compared to 30 times. Now they're betting on the expected turnaround in their Domino's stores. Over there, they're expecting a better turnaround in the same store sales growth. again. So apart from this also, while this is the main story for which they are doing this upside, the other upsides also include that they are now focusing more on the cost control side, along with the better number of new ventures going forward to the business, which are the two other tailwinds adding to the business. However, we have to also take in account some of the downside risk, which includes the deterioration in consumer sentiment. Again, if you have to look in the pizzas category as well, competition has remained a tight focus with more players coming into focus. So this has led to the margins as well. Also, there is limited traction in new products, which can add to this, and escalation in any kind of OPEX like that, operating related costs can be another downside for the business. So again, Citi maintains a buy rating on Jubilant Food, and this is at a target price of about 663, which is a 14% upside from current levels.
That's a buy call coming in on Jubilant Foods by Citi. I mean, as you track Jubilant, fundamentally, is there enough reason to buy the stock, you think? Is it on your recommendation list?
Yeah, I think clearly, the QSR space has emerged as a strong, kind of beneficiary out of the consumption theme, which most people track. And I think, if you look at not only Jubilant, but even the other companies like Restaurant Asia, typically Devyani International, these are all companies which are now witnessing strong volume growth, not only on online, but even their dine-out facilities. So I think, despite the fact that these companies traditionally have always traded at fair to expensive valuations, the brand franchise and the volume growth opportunity over the next, say, couple of years, I think looks quite promising. I think I would suggest that if anybody wants to buy, they could probably buy in a SIP kind of mode, and to ensure that they get the benefit of averaging. But yes, longer term prospects are good. In the very near term, we expect range bound movement in these stocks, because unless we see strong quarterly numbers, especially from the June quarter numbers which are expected, I think the markets would give a clear sense of re-rating once numbers are firmly established and we see strong volume growth as well as margin improvement.
Okay. Well, that's with the QSR piece. I wonder if Jubilant Food can really have that big a start. My question, Shrikant Chauhan, is that if Jubilant Food works, if it starts off higher today, is it showing any kind of strength on the chart setup to warrant a trade?
See, like Niraj, it is moving upward since last almost 2 months. It was around some 450, 430 levels. From there all the way, now it is at 580, 82 levels. And market is also looking for some defensive. So we may see some action, but I'm not expecting any major activity in the near term. I mean to say from here, we could see the levels of 600, 605, which is hardly any like upside from current levels, 4 to 5%. But yes, it is going to remain in a range of, let's say, 40, 50 rupees. 600 and 550 should be the range for the stock. And if we see the stock is opening somewhere close to 590, then I think it is better to stay away from taking any trade. Yes, if there is any correction in the near term, certainly we should look for adding the stock somewhere close to 550, 560 levels.
Right. Buy Jubilant at corrections is Shrikant's view on the stock. A quick check on the implied Nifty. We're gearing up for a decent start, at least on back of the handover that we have from Wall Street, and a good trade across Asian markets as well. 50-point gap up is what the markets are eyeing. We'll take a break. We'll come back, track pre-open, and gear you up for trade. So stay tuned.
All right, back with India Market Open right here on NDTV Profit in conversation with Shrikant Chauhan and Avinash Gorakhshekar. And what stood out amongst other things in trade yesterday, one was autos, of course, when he spoke about that. We should try and speak about the paint companies as well, because the field day yesterday, more so in the afternoon, I'll talk both about the charts and then about the fundamentals too. But the charts first, Shrikant Chauhan. Asian Paints, Indigo more importantly, but even Berger and even Kansai Nerolac. Good moves there. The stocks ended nearly at the day's highs. Volumes look good yesterday. Is there more coming?
Yeah, it looks like the way they have spent time at lower levels since last almost 3-4 months. And despite there was recovery in the crude prices from the levels of 75 to 85, we saw a good amount of buying attraction or consolidation sort of activity. In fact, most of the time, whenever the crude has moved to the next levels, we saw correction in all these stocks in the past. But this time, since last 3-4 months, they were like holding above their important support levels, specifically Asian Paints, which was holding above its important level of 2900. And now, based on its technical pattern, the stock can move to the levels of 3200, 3250 in the near term, which is like decent upside from current levels, because it was like underperforming and the overall move is showing some constructive pattern. At the same time, if we go through with Indigo Paints, then there also it has formed higher bottom. Yesterday, the volumes were much bigger than last almost 3-4 months, which is positive. And based on its technical pattern, I think this one is also moving towards the levels of at least 1750, 1800, where it has spent a lot of time in the past. So there also we are seeing some 10% sort of activity. And for other than these two stocks, we like Kansai Nerolac, because there also the formation is quite positive, and it is also heading for the levels of at least 320, 330. So these three stocks are really showing a lot of strength.
Okay. So those on paint companies. By the way, the pre-open session has started. We'll mark that, of course, as the day goes by, as the hour goes by rather. But starting off on a positive note, not surprising there. But Avinash, the same question to you really. Shrikant seems to be constructive on 3 out of the 4. So the chart's looking very strong there. Fundamentally, would you buy a paint company this morning?
Yeah, I think, Niraj, looking at the fact that, earlier, about 2 to 3 months back, the news flows about fresh competition had actually beaten down the existing players like Asian Paints, Kansai Nerolac, Berger Paints. But I think, competition is yet to make a big dent. And I think it would at least take 2 to 3 quarters before we could see any impact on market leaders like Asian Paints. I would also be more positive on Kansai Nerolac and Asian Paints. Typically, this is the start of the financial year. So I think you could see a little bit uptick in the volume growth of these companies. And I think, raw material prices have also been benign. So I think clearly with the kind of growth in the real estate market, construction activity have picked up, plus domestic automotive sales have also done very well. So I think, companies like Asian Paints, Kansai Nerolac, which has got a very large exposure in the industrial segment, I think looks definitely promising. And I think valuations have also come off a bit. So I think, somebody who wants to take a 12 to 18 month view can definitely start accumulating now. Definitely margin improvement comes in, and which is accompanied by good volume growth. That could be a kicker for the companies, going forward.
There'll be a few names that have been focused this morning. Tata Elxsi, Kesoram, Sula Vineyards. These are stocks that will be reacting to their earnings in early hours of trade. Well, one of the stock that has proved to be pretty dependable and reliable has been RIL, at least in last week's trade. There's been a report out this morning where Jefferies has maintained a buy call on Reliance Industries. The reason they're maintaining that is because they think Jio's public listing looks very possible in calendar year 2025, and that could be the big trigger for RIL. Shrikant, technically first, what does RIL look like? Is it a good buy at these levels?
I think, see, like if there is a very short-term view, then it is better to stay away from taking position at current levels, because it is very close to the crucial resistance level of 3,200 and 3,250. So upside is very much limited in the near term. But yes, if there is a medium to long-term view, then certainly we should look for adding this stock to the portfolio, positional portfolio. The reason is because it has spent a lot of time below the levels of 3000. And after crossing these levels, we saw a good amount of buying attraction, and it's a decisive breakout that we saw on the price chart. So based on its weekly or monthly chart, I'm going to say long-term charts, the stock is showing a lot of strength. Based on its long-term charts, we are expecting stock to move towards 3500, 3550 in next few weeks or months. So it will take time. But in the near term, I'm expecting stock to consolidate within the range of 3050 and 3250 on the high side.
Right. Avinash, what do you have to say about Reliance Industries? I mean, Jefferies believes there's a 14% upside on RIL from current levels. They are expecting a listing in calendar year 2025. And they've also said that Jio could list at a $112 billion valuation, which is a 7 to 15% upside on RIL. Are you in agreement? Do you feel like that is likely, and hence RIL could be bought from the medium term perspective?
Yeah, I think, if the investment time frame is slightly longer term, I'm not in the positive in the short term because the stock has already moved up. But I think, key triggers like the Jio IPO, which is going to unlock a significant amount of value to Reliance, is obviously going to come at a decent premium. They have been getting the benefit of increased ARPUs plus, I think, a large, customer base. So I think, markets were expecting that earlier the retail business could possibly go for an IPO offering first. But I think if the Jio offering comes in early, then I think probably the premium, which is now being given to most of the telecom companies, considering the kind of buoyancy in telecom, market, should definitely benefit the overall valuation for Reliance and Jio. So I think definitely around 3,000 odd rupees would be a good entry point. Despite the fact that, in Reliance, I think we would suggest to buy slowly and obviously, put a SIP approach. Because I think over the next 12, 18 months, you could see a lot of value unlocking initiatives coming in, which would obviously add a lot of, upside to the stock, going ahead.
Okay. Well, it's a day which is marked by some key brokerage notes. One principal among them might be what Harsh is bringing for us. Harsh, what is the big brokerage call for the day that you've chosen?
Well, it's Nomura on Ambuja Cements. Very interesting note coming through from Nomura. With regard to this, they've upped their target price from 500 rupees to 780 rupees on Ambuja Cements. Potential upside 17% from here. Now, just why is this huge upside that Ambuja sees? First off, strong capacity expansion expected going forward as well. Another round of inorganic expansion is what Nomura believes that Ambuja Cements is open to, and therefore will likely lead to more consolidation, especially for a player like Ambuja. Also, highest volume growth in the industry is what they are projecting for Ambuja Cements. They are expecting or in the process of adding roughly 24 million tons in terms of capacity by FY26 as per Nomura's projections. The Peña acquisition, of course, helps it become the third largest player in South India and now is behind Ultratech and Ramco in that sense. They've offset ACC's lack of brownfield capacity expansion. Now, estimates with regard to FY24 to 26, volume growth CAGR expected at 13%, EBITDA CAGR expected at 28% as per Nomura's estimates, and that is above Ultratech as well according to Nomura. So they've upped the target multiple on Ambuja, thereby increasing the target price. 14 times was the erstwhile target multiple, now at 19 times. Sum it up, aggressive capacity expansion, newer market entry, industry volume growth, very solid brownfield optionality and cost optimization. All of this should drive that EBITDA number, 28% CAGR.
Well, Ambuja and pre-open is looking great, 2.5%. That's quite a sharp up move for a cement company on a brokerage report, I'd imagine.
It is. I wonder if Kesoram is echoing that, or is it...
Kesoram had a disappointing quarter.
Very disappointing quarter. No, I'm wondering, because cement expectations aren't the best. We should pull up Kesoram as well at the end of the pre-open session, what that is doing, just to see. 1%.
Not too bad.
Yeah, okay. Well, wonder, Avinash, what would you buy in cement if you were to buy cement?
I think, Niraj, companies which are having a very strong geographical presence. I think the larger players, I think something like Ambuja Cements, typically an ACC, typically an Ultratech. I think we still continue to be more positive on the larger players, because the raw material price benefit is going to actually help these companies. And plus, pricing power is something which actually benefits companies which have got a good geographical spread and which have got a large capacity. So I think, we continue to believe that pan-India geographical coverage is very important. Size is very important. So I think it's better to bet on these 2-3 companies. And I think once the quarterly numbers come out, hopefully, April to June should be a good quarter. And thereafter, the monsoon kicks in. So I think the second half for these companies is going to be a lot better. And whatever, announcements do come in the budget, there are broad expectations that infrastructure would be given a further boost up in this budget. And that definitely would play a big role in ensuring that a lot of new projects get assigned, and obviously cement as a kind of a sector, benefit. So I think Ambuja and Ultratech, as well as typically larger players like even in the south like Ramco Cements, these are companies which I think one can gradually equip.
Wow, well, big moves there on some of the cement names today. Actually, not big. Ramco is up just about 0.78%. But has done well. Actually, can we pull up the 3-month chart of a Ramco Cement, a 3-month chart of KCP, that's the other cement stock, based out of Andhra Pradesh and Telangana, that region. Just want to pull up the 3-month chart. Look at that. Ramco gained quite a bit and then completely came off. I don't know if it gets a fillip today. KCP, on the other hand, should come up on your screen 3 months, has actually done well. It's trading at the highest point in the last 3 months. So interesting, some of those names. Shrikant, very quickly, Ambuja on the charts, 2.5% higher. Can it do more today? Would you trade it?
No, I think it is like it will open somewhere close to its resistance level of 690, 700, where it has found some selling pressure when it was moving upward in last few days. So I'm of the view that it is in the range. It is going to find resistance somewhere close to 700 levels. But at the same time, the downside is also limited. Somewhere close to 650, 660, the stock is having excellent support. So in case if we see any correction close to 650 levels or 660 levels, there we should look for taking long bet on Ambuja Cement. At current levels, I think it is better to take some profit if it is very close to the resistance level of 690 or 700. But we like Orient Cement, and this one is doing much better as compared to other cement stocks. It is currently around some 310, 312 levels. But based on its technical formation, I think it is heading for the levels of 350, 55, which is like a much better upside as compared to other cement companies in the near term. So it's a buy at current level with a stop loss close to some 295 on the downside.
Well, there's been a Moody's upgrade coming in on Yes Bank, and that's turning out to be quite the star in today's day of trade. In pre-open, it looks like it's a 5% grab up on the stock. Shrikant, if you get Yes Bank at 26, it's a sign of strength. So would you buy into Yes Bank? It may just be one of these outliers amongst all the banking names today.
Yeah, with the trading purpose, certainly we should look for taking long bets on Yes Bank. The reason is because it is forming some rounding bottom sort of formation. And based on its formation, the stock can move back to the levels of 34, 35. It will take some time because it's a rounding bottom formation. But yes, in the month of February, it was around some 34 levels. So around those levels, again, we could see the stock based on its technical formation. So at this level, the risk reward ratio is quite favorable. With a stop loss at 23, I think we should look for adding these stocks with a positional view.
Well, 4.5% higher for Yes Bank though today. Avinash, are you a buyer in Yes or any other banking name, but Yes predominantly?
Yeah, I think, Niraj, Yes Bank is now a completely well-managed bank. And I think now the news that RBI has also given a go-ahead to SBI to sell the stake. SBI holds around 24 or 25%. So my sense is that now I think the near-term trigger for Yes Bank would be that, which is the entity which is going to buy into Yes Bank. I think clearly banks as an entity are always an attractive option, for a lot of, groups who have not got a bank license. So I think it would be interesting to know who actually gets into Yes Bank. I think that would be the near-term trigger. But yes, I think numbers have improved. The quality of assets plus the balance sheet has also undergone a remarkable transformation. So I think around 25, 26, if one were to take a time frame of 12, 18 months, one could definitely expect a decent upside here. And within the banks, I think we still continue to be positive on the PSU banks like a Canara Bank, a Bank of Baroda. We still believe that these are the banks which have actually not proven their entire potential. And I think once the Q1 numbers come out, hopefully we believe that the kind of commentary these bank managements give out would be definitely be a lot more reassuring. So I think SBI, Bank of Baroda, Canara Bank, I think these are definitely looking attractive. I think one should definitely accumulate them at the current order.
Right. Very quickly, Shrikant, we've got a minute to go before we go into market open. A start around 24,400 is what we're eyeing. Intraday, would you go long on the Nifty if you get a start at that level?
No, I think it is rebounding after hitting the levels of 24,100. So somewhere close to 24,400, we are expecting some resistance in the market. So it is better to stay away from taking any specific bet on the market. But yes, stock specific action is there. So we should look for adding some metal stocks to the portfolio.
Okay, which metal stock, Shrikant? Which one would you bet on?
See, currently it is showing Hindalco to open on the higher side, but technically also the stock is showing a lot of strength and the stock can move to the levels of at least 720.25 in the near term. So Hindalco looks very decent candidate to buy at current levels with a stop loss close to 690.
A non-ferrous name in Hindalco is what Shrikant is betting on. Well, let's see if there is strength there. It is his top call. He says it could go to 720 or 725 odd levels in the very short term. Stay on, gentlemen. We'll talk about how the market is open and your final thoughts immediately post open. But here's how markets are starting off this Thursday morning. On the back of the whole of Asia also looking pretty, Indian markets are starting off in the green. 0.25%, but in the green nevertheless. Actually cooling off as well a little bit. So all over the place, just about 0.2%. Wonder if banks are participating or is it some other sector? Banks too, 0.25% or just about there. Nothing too dramatic. Almost even Stevens. Mid caps and small caps, let's see if they are in the green. 0.25% for the mid cap index. Our small caps doing a lot better. Let's see, well, about 0.5%. Nothing too great, but 0.5%. Not bad considering the kind of fall that we had yesterday. Remember, it seemed like it's all correction coming up. Let's get the heat map up on the screen. I'll mark the large caps. Samina brings up the small caps and the mid caps then. A lot of green, very little red. The breadth, by the way, was okay yesterday too. What's correcting? Ultratech is down today. ITC is down. HDFC Bank, yet another day of a downtick for the big boy. A BOFA downgrade day before yesterday led to a downtick yesterday and downtick today. What's doing well? Tata Steel, Hindalco, well, metals are doing well. Asian Paints, after their uptick yesterday, yet another 1% up move. Titan recovers a little bit of lost ground. Axis Bank, Tata Motors are amongst the others. I don't see M&M. I do see M&M. It's flat, but it's not essentially a very large loser in trade. I don't see Maruti in the list of the top gainers. So, Samina, it seems to be that it is metals. To an extent, ICICI Bank bouncing back despite the Axis Capital downgrade, but more green than red, even though the gains are only 0.25%.
Yeah, but it's not very convincing just yet, right? It doesn't seem like it's that big bang rally that world markets have seen or are seeing in Asia this morning. 0.2% higher. There is a little bit of nervousness at higher levels, which is very obvious from what we are seeing right now. Could be another morning of consolidation. We can't rule that out. The breadth is good, and that is what the bulls may be taking heart from this morning. A quick check of how the broader markets are doing. Again, no fireworks here either. Mid-cap and the small-cap index doing pretty much in line with what the benchmark is doing. The mid-cap is up 0.2%. Remember, yesterday saw that big fall and then a sharp recovery. So building on to that recovery is what we're seeing in the mid-cap and the small-cap index. But lots of stocks from the broader markets that are on a radar this morning for good and bad reasons. A bunch of earnings that have disappointed the street. But of course, you've also got a couple of brokerages and upgrades coming in. Yes Bank is the stock of the morning, 6% higher as Moody's upgrades the counter. They believe there's a gradual improvement underway at Yes Bank. Markets get excited. The stock opens up with a gap of 6%. Technically, in fact, Shrikant believes that this could actually be further upside on the stock, and you could see levels of 34, 35 in the medium term. Glen Pharma, that stock is under some pressure on back of promoter stake sales. So that really is on back of a block deal. The stock doing what it's supposed to do when there is a big stake sale on it. So Glen Life and Glen Pharma both seeing some pressure. 2.5% and 1.5% lower is what we have in trade this morning. Tata Elxsi numbers were disappointing. Quarter on quarter, you've seen weakness. Year on year, you've seen weakness. And you've also seen reporting that's coming slightly below than what the street was expecting. The stock trades the cut of 2%. Big order win for Kalpatru projects. The stock gets a thumbs up. Just before pre-open, we heard that they've bagged an order to the tune upward of 3,000 crores, on back of which the stock sees a gain of 4%. Decent quarter for Sula. They've managed to have the best revenue number his ever, on back of their own brands doing quite well. Of course, what didn't work for them is tourism, wine tourism, and despite that, the stock is getting a thumbs up on a set of good numbers. So all in all, it's a mixed sort of morning that we're seeing. RVNL, I'm pulling it up. No reason why the stock is higher, but it is higher once again. Trades with a gain of 2%. Zydus Life, which saw a gap up at 9.15, has now gone back into negative territory. They've had an important approval coming from the US FDA. I would expect the stock to start building on those gains very shortly. So it's flat as we see it, but I won't be surprised if it goes home with a significant gain in today's trade. IRB Infra, on back of the toll numbers, the stock looks good. So all in all, Niraj, the stocks are looking okay. Ambuja, on back of an upgrade, is up about 4%. So it's a morning where you're not seeing double-digit gains, but you're not seeing double-digit losses either. So I'm taking heart from that. But all in all, your best performer is the Yes Bank and Ambuja.
Yes Bank clearly standing out, Ambuja standing out, but Mazgon Dock, Cochin Shipyard, etc. have all done well. Yesterday's top gainer, Shoppers Stop, corrects about 4.5%, so watch out for that. Real estate is having an iffy day. Thermax, valuation concerns coming to the fore. I've seen a couple of PMSs talk about whether the valuation concerns are now right up there. So watch out for that. And Philips Carbon Black actually is the top gainer now, up about 5%. Solar is back to winning ways, 13,000 for Solar Industries. This is quite a stunning move for this stock, must say. Excellent moving. A stock, though, that has done really well is GE Shipping, yet another 3.5%. Before I go to Shrikant Chauhan on that, pull up the 7-day chart of GE Shipping and let's see what's happening there. Big move there. Last few days, it's had a really strong run. As we get that chart, Shrikant Chauhan, opening thoughts, any stock that catches your eye, but GE Shipping as well. Big moves the last few days.
Yeah, I think GE Shipping is certainly showing a lot of strength on daily as well as weekly charts. In fact, on long-term chart, it is just going up and up after crossing the levels of 900, 950. But even if we see the trend of last few days, then it was consolidating after rallying to the levels of maybe 1450, 1400. Now again, there is a breakout sort of formation. So based on its technical formation, I think it is heading for the levels of maybe 1700. The overall formation is strong. But at the same time, if I just want to see any other stock, I'm to say the stock from the broader basket, then in that Zomato is now above its important crucial resistance level of 213, 214. Below this level, the stock has spent nearly 7-8 days and now it is crossing this level. So it's a technically very strong candidate to buy at current levels with a target of close to 225 to 30. And along with that, we also like a few cement companies. And in that, as I mentioned, Orient Cement should be on the watch list. It is around 313, 314 levels. There we are expecting further more upside during the day.
What are you doing, Shrikant, with some of those tire companies? We saw them make record highs only a few weeks ago, but since then, most of them are seeing some weakness. Despite most analysts believing that they seem to be in a structural uptrend. Anything in the tire pack that makes a good buy at these levels for you?
So technically, all these stocks are showing some consolidation, and since January we are seeing some correction, but at the same time they recovered in the month of March, April. So broadly, I'm of the view that they are going to consolidate further more from current levels, and I'm not expecting any major firework till the stocks are not crossing their previous highs. I'm going to say CAT is comfortably trading below the levels of 3,000 since the last almost 4 or 5 months, and it is not crossing to the same. But yes, on the dismissal of 3,000, certainly we could see some more uptick. But I'm of the view that in the near term, they are not going to give any major firework.
Right, that's the call coming in on some of those tire names. Fiat actually is up 1.5%. Apollo, on the other hand, is seeing a little bit of weakness. Avinash, if you had to buy a tire company, one, would you? And if yes, which one would it be?
I think clearly, I think companies which are focused on the passenger car and the two-wheeler segment, I think Fiat definitely looks interesting. My sense is that, this is one company which has got a very large product category base, a large customer base, and plus, they have managed their inventory and raw material management pretty well. Only clear, I think, concern is on the crude oil prices. I think if these crude oil prices remain stable, then I think one could expect a decent risk reward even at the current odd levels. I think levels of around 2900 or 2950 over the next, say, 12-15 months look very much possible, considering that a lot of growth is now going to come on from the volume growth. Expansion plans have also been on track. So I think Fiat at current levels or even maybe at slightly lower levels could be a good portfolio bet for an investor looking for a good risk reward.
Okay, well, that's as far as tires go. Solar industries. I mean, we talk about defense names, and yes, there is a Mazagon, HAL, etc. But solar industries, the last 1 month has probably been the best performing name. Must be 30% gains at the very least, and the market cap comfortably above 1 lakh crore. It's 1,20,000 crores if I'm not wrong. Stunning gains here. If you had solar in your portfolio, Avinash, would you sell it?
No, I think it depends, Niraj, on what price you have entered. But I think for a long-term investor, wealth creation has been massive for this stock. And I think one thing is very clear in the explosive market. They have a large market share, and plus they are large suppliers now even to the Indian defense market. So I think, the markets are clearly looking at these two triggers with infrastructure, spends increasing, specifically with Coal India increasing its production. My sense is that, both these factors are going to play a very important role. And clearly, this being a monopoly business, not many companies come near to it in terms of their technical expertise, in terms of their geographical reach. I would believe that, somebody who's got a 2-year kind of time frame should definitely hold on because, as long as the earnings growth story continues to be rock solid, there's definitely a good scope for this stock to get further re-rated. The market loves it, and I think the management has also been very focused. Clearly, I think these are two factors which are quite positive for the stock going ahead.
Really seems to be in love with Yes Bank right now. The stock is up 7.5%, one of your top gainers on the index on back of that Moody's upgrade. What worth mentioning is also tech earnings will kickstart in full stream with TCS reporting as well. But just before we go to that, Shrikant, on the charts, any tech company that you would go long on today?
See, like all these tech companies, they are forming some specific reversal pattern. And most of these stocks are very close to their crucial resistance levels. Like TCS is finding difficulties to cross the level of 4,050. But whenever there is a recovery in the market, whenever there is a rally in the market, we see the stock is hitting to the levels of 4,050. So on the dismissal of that, yes, we can see furthermore upside for TCS. But based on technicals, we like Wipro, which is around some 535, 540. And on long-term charts, the stock has formed some bigger consolidation formation. And based on that, the next level to watch out for would be somewhere close to 700. So it's a big upside that we can see based on its technical formation. So I think at this level, Wipro is a very a positional bet to buy and hold with a stop loss at, let's say, 510 on the downside because the upside is bigger. So keep a stop loss of at least 20-30 rupees for creating long position on it. But yes, there is upside. So it's a buy at current levels.
That is technically a buy on Wipro. In fact, last week you also had a double upgrade coming in from CLSA on Wipro. But Avinash, what about you? What are you doing with the IT pack? Are you placing bets on the long side ahead of earnings here?
I think clearly, IT is in momentum. And my sense is, I think we've been telling our clients that, stocks like Infosys, typically an HCL Tech or typically even a Tata Technologies, these could be good defensive bets considering the fact that, they have turned very attractive in terms of value. I mean, the growth quotient still seems to be missing. And I think, investors who can take a bet for the next, say, 6 to 12 months would definitely look at these companies. I would believe that, once the Q1 number comes out, the commentary comes in, we could get a lot of sense of assurance and conviction as to what is happening on the ground. The US market continues to be challenging. And I think considering the fact that, the macro commentary continues to be a little cautious, we'll have to probably wait till September, and only then we could see stronger earnings numbers kicking in. So I think as of now, maybe somebody who's got a very long-term kind of time frame and wants to allocate, say, 2-3% of his portfolios can definitely look at Infosys, TCS, or Tata Technologies. These are all defensive bets. But yes, the real growth quotient could come in only post-September.
Well, it could be, and in fact, it seems like some believe that the IT sector would have potentially weathered the storm, and maybe this is the end of the downgrade cycle for the sector. But Tata Elxsi, like I had said, had reported numbers, while top line saw marginal uptick. Bottom line was slightly disappointing. The stock, of course, is trading with a cut of 4%. But before we take that break, listen to what Tata Elxsi's management had to say as they talked about the earnings and the fact that they see green shoots now, at least in the media and telecom sector. Listen in.
From an FY25 perspective, definitely, again, growth will be led by transportation. Our industrial design, business is also showing, accelerated growth. And actually, the initiative that we started in terms of design digital and combining design with our, embedded offerings is really, really resonating with the industry, and we're seeing, good traction. We are seeing green shoots in the media and communication space. A lot more discussions happening. A lot more customer traction is there. There are, significant, consolidation opportunities that we are bidding for. So we are hopeful that, we will see a turnaround in that particular business. Healthcare, as you know, is a relatively smaller business. We have to, really work through this particular one engagement. And unfortunately for us, healthcare business is also, the number of customers is also not too many. So we have some, pretty good logos, good customer base. Unfortunately, even if there is some issues in one or two of those customer bases also, we will get hit, right? So our aim is also to broad base our customer engagements in the healthcare space.
back. You're watching India Market Open. It's all eyes on the IT sector that kickstarts the earnings season with TCS and Infosys reporting soon. Well, the big question is the downgrade cycle now finally coming to an end for the IT sector? Well, Richard is standing by with what the expectations are on TCS that reports soon and also from the sector at whole. Richard, it's over to you.
Thanks, Samina. So I'll start with overall what to expect from the IT earnings season this time. Number one is the trends in the discretionary demand, which has to be watched out for. Next is the client's budget outlook. Now, clients have been cutting down their budget and reducing their IT spends, but this is what we should look out for. Next is the speed of conversion of deal wins into revenue. Now, this also has been under pressure. Companies like TCS also saw deal cancellation and pauses in the last few quarters. So this is another major point that has to be watched out for. Moving on, we also have Accenture results, which indicated a stability in discretionary demand, if not a downtick, because it maintained its guidance and also registered highest ever bookings in the managed services segment, which is relevant for the Indian IT companies. Moving on, we have revenue growth guidance. Now, guidance is what the investors are looking forward to. Majority of the brokerage houses expect them to maintain the guidance, and TCS is expected to register about 1.5% of revenue growth, while HCLT is expected to be a laggard and report a negative earnings growth. Infosys likely to lead the earnings growth this time. Moving on to margin expectations, we have Citi, CLSA, Jefferies, Kotak. Everyone believes that TCS will likely report a dip in margins, likely due to wage hike this time. Moving on, we also have average of HCLT around 17% this time, because this can be backed by the strong deal wins that the company had. Also, talking about the dates TCS to report results today, HCL Tech tomorrow, and next week we have LTIMindtree, Infosys and Wipro as well on the line.
Right, that is what is in store for the IT sector. It's TCS that kickstarts the earnings season, and the big question to ask is, has the IT sector weathered the storm? Well, Sandeep Agarwal, fund manager and co-founder of Soilo Investment Manager, joins in. Hi Sandeep, thanks for joining in. Earnings season is on the verge of getting kicked off with TCS and Infi reporting soon. Do you feel like this will mark the end of the downgrade cycle for the IT sector?
Hi, good morning, and thanks for having me on the show. So, I am fully confident that this quarter will start the upgrade cycle. I am not even thinking of stopping of downgrade cycle. I think it will start the beginning of the upgrade cycle, and I will tell you key reasons why. See, in last 4 or 5 quarters, if you see, attrition has been consistently falling. The subcon cost, so attrition from a peak of 28, 29% for even TCS for 4 or 5 quarters back has now again come back to 12, 13% level. Second, the subcon cost, which had crossed 10% even for TCS, are now back to mid single digit kind of numbers. So all these things are huge contributor to margins. And if your margins start going up, then what happens? The comfort on executions comes significantly, and also it gives you a more leeway to get more business. So I think we, in my view, the stocks have made a bottom in the last quarter from a stock price perspective, because markets are always forward looking, so they discount all the negative and positive very quickly. And I think this is the quarter when you will actually see upgrades led by margins. I don't see this sector, at least the large caps, are in such a shape, or the industry is in such a shape where you can see big upgrades in growth, because growth numbers are going to be 8-10% for the large names. In some good quality mid cap names, you can see 12 to 14% kind of growth, but the margins are the key thing, and I think margins will start picking up from this quarter. That is the way I look at the sector.
Okay. Sandeep, good morning. Niraj here. Lest you think we only talk to you about IT. Today, yes, we will, but very soon we'll have conversations across the market too. But let's focus on today on IT. It's a big statement you're making that it marks the beginning of an upgrade cycle. Now, since Accenture numbers came out, we've seen a bit of an uptick in IT companies, and the valuations are no longer what they were maybe a month and a half ago. You reckon the best is yet to be priced in?
Yes, I think, see, Niraj, this is a very interesting sector. You have to see that last 20, 30 years, so it is a mature industry. It is no more at a stage where, you can see very good growth, very high growth rates and all. exclude the COVID year, what happened is that the demand came up in a very big way because prior to that 3-4 years, the growth was low and there was a disruption which started led by digital. So there was a pent-up demand and there was a demand because of people preparing for work from home for an unknown period of time. So everything got bunched up and you saw that 20-30% kind of growth. I don't think that can happen regularly because you have to remember that global spend on tech goes up by 2-3% and outsourcing goes up by 5-6%, and we gain market share every year. So our industry grows at 8-9%, and within that the large players will grow, let's say 1 or 2% higher, and the good quality mid cap can grow at 4-5% higher, and the smaller, very small ones, unorganized ones actually can decline. So that is the trend. So in this industry, we have to expect a steady state growth rate of 8-10%, and that is where it is. So I don't see a very big jump, but I think that 15-20% upside in the good quality large cap name is very much imminent, and it will happen very quickly. Means it doesn't take a year for that to happen. In tech, if you see, whenever good news or positive things, momentum comes, everything gets discounted in just a month's time. So this time will be no different. But I will be a little cautious on the good quality mid cap names because there, they are priced to perfection. So I don't know how much more upside will be there, but I can tell you the whole sector will see a good margin upgrade, and because of that, the EPS will see a good upgrade across the sector.
Sandeep, just to play devil's advocate, while we take your point that the run-up may be very quickly and immediate almost, the fact remains that there is still no immediate signs of demand recovery. I mean, sectors like BFSI, retail, telecom continue to face challenges. Do you feel like that could be a little bit of a concern? I mean, that could be a risk that we are staring at as the leaders will announce numbers soon?
No, it is a very valid question, but let me give you two anecdotal evidences. Post-Lehman crisis, one of the largest Indian IT company at that time gave a decline guidance of 5-7%, and they ended up the year with 15-20% growth. Similarly, in 2021, post-COVID, most of the companies which started with a negative guidance for the outlook for the next year, they all ended up at 20% growth. So this is a B2B business. 30-40 clients give you 85-90% of the business. So the first sign of recovery or first sign of positive you should draw is when your attrition is almost at bottom, which indicates that no one is hiring. And second is that when there is a stability. So if you read in between the lines for Accenture numbers, as already rightly mentioned by the previous speaker on your channel, we saw that managed services was quite strong, and also the discretionary spend was showing a sign of stability. So this is the first sign, which means that there will be no decline, at least there will be no project cancellation, there will be no deal cancellation. So I think that is the first sign. And in my view, as I would repeat that, the stocks have made a bottom in the previous quarter. This quarter, next quarter, probably they will make maximum out of those 15-20% return, which is expected. And post that, again, you will see time correction for maybe 6 to 9 months. That is the way I look at the sector. And I think, in a B2B business, it is very hard to even for the chairman or the promoter of the company to call out that, there are signs or not, who are interacting with the customers every day, because the size of the deals are so big that 1 or 2 deals can make a big difference to everything.
Okay. Sandeep, so where are you constructive on? I mean, are you constructive on TCS, Infy, HCL, large IT service vendors? Are you constructive on the mid-sized ones? Because some of them have stated that they'll be a lot more nimble and agile for the generative AI or the AI piece. Or are you constructive on the ER&D names? Because those stocks are not seeing any sunset. Most of them, KPIT, etc., or product companies like Persistent, are really doing well.
So, all the three very interesting questions, I will answer one after another. So first of all, I am very constructive in the large cap space in the names which are not expensive and where there is some turnaround. So TechM and HCL Tech, I think there is good upside. HCL Tech, will always have 1 or 2 bad quarter out of 4 quarters. So it is not a company which will give you all 4 quarters very good or stable. So compared to that, HCL Tech will always give you stable to decent quarter. Infosys will have 1 bad quarter, 3 decent quarters. HCL Tech can have 2 bad quarters, 2 very good quarters. So these companies have different kind of business models. But I think at current valuation, TechM and HCL Tech both are good bets. I would say that if Infy and TCS can give you 10-15% from here, these stocks, if you keep for a year, can give you 25-30%. So that is number one. Coming to your second question, that good quality mid cap. So you are absolutely right. In the mid cap also, you have to bifurcate based on their offerings. So the IT services ones, I would be a little cautious because, there, I think they are very expensive right now. And even if good growth comes and margin improvement happens, they don't become cheap. So there could be a 10-15% upside because of their small size and lesser liquidity, but they are not at all one which you should look at. The third space, which is ER&D, I think that is the most interesting space, and the reason for it, see, last 30 years, what we have achieved is massive penetration in the developed market, particularly the US, and to some extent in UK and Europe in the IT services space. Now, if you see the whole world, because of this smart products uptick, which is taking, every product is becoming smart, everything is getting connected, generative AI and everything. So you need connected world, you need connected data. So for that, what is happening, that every product which anyone is making, even the washing machines, the refrigerators, the coolers, the ovens, every equipment, household equipment, everything which you use in office, home, everything is now connected, and data is continuously monitored and controlled. So for that you need smart product, and that smart product means that when you are developing the product itself, you need someone who can bridge the gap between a electronics engineer or mechanical engineer or metallurgical engineer and a software engineer. So that is the reason ER&D is picking up in a very big way. In my view, there is much more shortage of a software engineer with mechanical engineering knowledge and other engineering field knowledge. And because of that, ER&D is now picking up in a big way, and the penetration level is very, very low. So I think that 10 to 15 years, ER&D outsourcing could do very, very well for India. And that is the reason, Persistent, KPIT, Tata Elxsi, all LTTS, all these names which you mentioned, despite not delivering good numbers in 1 or 2 quarters, they don't go down much. There is always a buyer who stands, because they understand that what they have seen in last 20, 30 years in IT services, they will be seeing that in next 20, 30 years in the ER&D space. So it is a long-term, very substantial return bet, in my view.
Wow. Okay.
Right.
Okay, Sandeep, this is great. Lovely talking to you today on IT, but we'd love to have you to talk about the wider market as well one of these days. Thanks for your time today.
Thank you. Thank you so much.
Well, that looks like it could be a good quarter for the IT stocks. The stocks aren't doing too badly either, maybe on the sidelines, out of numbers, but at least for what we believe, the downgrade cycle could be coming to an end for the IT sector. And these stocks, while have ran up, may continue to eke out some more gains going ahead. Nifty IT at its day's high point, largely expected on back of very strong global cues that we're coming in with. So if inflation is easing, rate cuts happen in September, IT sector gets an immediate bump up, at least in terms of trade. And hence, all your IT names are looking good this morning as expected. Well, one other stock that's on our radar this morning is IRB Infra. This one too has been on a good, sweet run over the last couple of months. Lots of very optimistic and constructive brokerage calls as well coming in on IRB Infra. Well, the story this morning is they've reported very strong toll collection, which is up 35% in June 2024. As always, we have this Anil Yadav, Director Investor Relations of IRB Infra, joining in. Hi, Anil. Good morning. Thanks for joining us. It's been good for IRB Infra. Lots and lots of optimistic calls. The stock price is doing well. Of course, the toll collection numbers are also looking pretty strong. You want to break that down for us and tell us whether this trend could continue going ahead and what led to such a sharp reading on toll collections?
Good morning. Thank you. Thanks for the opportunity. With respect to toll collection, if you look at, we have seen a good traffic growth in spite of these months were affected because of the election was going on. And typically during the election period, economic activity is low. But still, I will talk about volume growth. Mumbai Pune has reported almost 5% kind of 5 to 6% kind of traffic growth. Ahmedabad, Vadodara has reported around 7 to 8% kind of traffic growth. And there was some asset addition also, which were not there in the last year. Those assets has also contributed. That has led a overall growth of 35%, including IRB plus private InvIT, as compared to the same month of the last year.
Also, just looking ahead, Anil, of course, the blip, like you said, was because economic activity was lower on back of election season, heat wave, so many reasons why things weren't as good in the past, and hence we've seen a bump up or lumpy growth for June. But looking ahead into the calendar year, looking ahead into FY25, do you feel like this sort of toll collection and growth could be sustained? I also believe the recent tariff revision could aid revenues quite significantly.
So the number 5 to 6% growth on Mumbai Pune, that was only driven by the volume, and Ahmedabad Vadodara, the volume growth, overall growth was around 12%. Out of that, roughly 3.36 was the contribution from tariff, and balance was the contribution from the traffic. So as of number looks great. And as everybody is predicting that the India GDP will be between 7 to 8% for this financial year. And typically that toll collection correlates the economic activity in the country. And considering the high growth in the GDP, we are bullish that in coming months also the growth should be robust.
Mr. Yadav, good morning. Niraj here. So, if I'm not wrong, Q1 toll revenue is up 31%. Despite all that you said, 31% didn't seem to be too bad a number. What's the number that can be anticipated if you say that this one was maybe a slightly wobbly quarter, but the quarter side could be better?
So I think 31%, if you look at the traffic growth for the quarter as whole, would have been in 4 to 5%. And typically we expect around 5 to 7% kind of traffic growth. And this number also includes the addition of the new project. And because of that, the growth was 31%. Going forward on the sequential basis with respect to the existing project, we foresee that around 10 to 12% with excluding the new assets, there will be 10 to 12% growth in the revenue for the coming period. So the traffic growth, which we have seen around 4 to 5%, that should be ideally between 5 to 7%, considering the GDP growth of 7.5%.
No, sorry, I'm just getting a bit confused here. The toll revenue is up 31% for the first quarter. Is that a correct number? Yes, it is.
Yes,
that's correct. So if you do 10-12% growth, what does it translate to in terms of revenue growth maybe for toll revenue, toll collection?
So if you compare with the current quarter with the last quarter, we have added 3 assets in the toll collection, 4 assets, that is Hyderabad Ovara, TOT 1213 and Samakhli, which were not contributing in the corresponding quarter of the last year. So that has also led this kind of exponential growth.
Oh, okay. But the second quarter onwards, the base effect becomes normalized, you're saying?
I think to a certain extent, yes, because Hyderabad has started from August 2023.
Got it.
But
Okay.
TOT 12 and 13, which is also part of significant, they have started from 1st of April this year.
Got it.
So I think the growth ideally should continue, not to the extent of 31%, but ideally closer to 20%. The growth in the third and fourth quarter should also continue.
Got it. Mr. Yadav, now, aside of tolls, I mean, just talk to us about the EPC order book currently, the bidding pipeline, and the states that you're talking to as well. Because there's a lot of talk of how Andhra Pradesh could see a massive infrastructure boom, and it could help a lot of infra companies which are pre-qualified. And there are not too many who are. You must be one of the few. So tell us a bit about the EPC side, the current order book, the pipeline, and the growth thereof.
Yeah. So we have 34,000 crores of order book, and we are in the space of BOT, TOT, and HAM. We don't bid for the government-funded contract. We only take BOT and TOT and HAM. And for BOT and HAM, execution is done by our EPC arm. So we have an order book visibility for 1.5 years. As there is a pipeline on the NHAI website itself, almost 2 trillion worth of opportunity, that is 2 lakh crores of opportunity in the BOT segment, and roughly 60 to 70,000 crores of opportunity in the TOT segment, which will unfold in near future. And today we have one of the best debt equity, that is lowest debt equity as far as sector is concerned. In terms of equity requirement, as against 2,500 crores of equity requirement every year. Now, all projects are already funded, and we have a very minimal equity requirement for the ongoing project. So we have a good appetite as far as new opportunity, which is going to unfold from the NHS side, that is the BOT and TOT. And our order of preference will be BOT, TOT, and followed by HAM.
Okay. So So therefore, as a console number, just before we wrap up, I don't want exact numbers because you must be in a silent period. We'll get to exact numbers after your quarterly numbers. But what's the kind of overall growth that can be anticipated? Not in order book, but let's say in terms of the revenue size for IRB Infra. Is there some guidance, internal growth guidance that you have in mind for FY25 and 26?
I think in terms of last year, though we have bagged almost 18 to 20,000 crores worth of project as against to 5 to 6,000 crores, but that only included one BOT where the size was roughly 1,600 to 1,700 crores. And accordingly, if you look at our EPC order book, which will get executed over the period of 1.5 years, that is close to 6,500, and roughly 2,000 crores is O&M order book. And we expect to bag more project. For FY26 growth, considering the government, more orders are coming from the government, FY26 may be much robust. But for FY25, what we have guided on our quarterly con call, 10 to 15% growth in the top line and same in the bottom line as well.
Got it. Okay. Mr. Yadav, wish you all the best. Thanks so much for taking the time out and being with us and giving us your thoughts. Really appreciate your time.
Thank you. Thanks for the opportunity.
That's IRB Infra, of course. Well, a quick check before we wrap up this show and commence talking point as to what's happening in the market. It's flattish, really, but Nifty IT has had a really good move. Nifty IT is up about 0.5%, if I'm not wrong. So that's to be kept in mind for sure. What is moving up? New India Assurance has had a big move, up 5% if I'm not wrong. So sharp up move there. I don't know if it's got to do with these insurance premiums and whether companies like HDFC Life or SBI Life have continued from where they left off yesterday. Should come up on your screen, both of them as well. So the insurance players are doing well today. There is Indus Tower, which is making a move. So keep an eye out for that one. There is Welspun Corp, which is making a bit of a move in the last few minutes of trade. And the star of the morning, to my mind, I mean, there are many, but the star of the morning has to be Shipping Corporation of India. Big bang move there. Now, it could be various reasons, including SCI being very close to divestment, but Shipping Corporation of India, this trending move on very high volumes, it's a stock that you want to keep at the back of your mind for sure. Wrap it up on this leg of India Market Open. Thanks for tuning in. Up next is Talking Point. We talked to a real estate company which didn't come with the best of numbers. And then, of course, follow it up with a conversation with Manish Sonthalia of MK. Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Real estate has been the talk of town this year. The index has gained 43% in the year alone compared to Nifty's 12% return during the same period. As the earnings season kicks off, though, several companies have started sharing the business updates for the quarter. One of these names, was Marathon Next Gen Real Estate. The first quarter pre-sales saw a decline of 46% YOY. Collections, though, saw an uptick of 17%. To put these numbers into perspective, because pre-sales can be a bit confusing, let's get in Mayur Shah, Managing Director of Marathon Group, on the show. Mr. Shah, good having you. Thanks for taking the time out. This is Niraj here. Good morning.
Good morning.
Can you put the numbers into perspective? Because most MMR players have spoken of very strong pre-sales and actual sales. The 46% decline from your end seemed a bit surprising to that extent.
In my opinion, real estate should be looked into, in a 6 to 8 quarters and not on quarter-and-quarter basis. Because what happens is that every project cycle comes to, around 3 to 4 year project cycle. And if you look at it, the last year, our first quarter, there were various launches which happened, and there were a lot of ready-to-moving inventory which got captured and sold. So, but the momentum of, if you look at our collection numbers, are still very strong, robust, on almost 278 crore for this quarter. So, the groups, the companies' launches are actually planned, the phase 2, phase 3 of the ongoing projects are planned in the second, third and fourth quarter of this year. So, these numbers really catch up over the period of time. If you look at our last year's results, it is already, there's a PAT is a jump by almost 36%. And our average realization, we being a Mumbai-based project company, average realization is also going up, almost like 11 to 12%. For the same built-up area sold, we are getting a realization more. So, these are the things. Overall, we are seeing a very good run for the real estate across our project, whether a luxury residential project or whether commercial office space that being built by Marathon. We are seeing a very good traction across the even middle segment at Panvel Marathon Night Zone with Atal Bridge now operational. It's only 40 minutes drive to the Panvel from South Mumbai, and that we are seeing a very good traction coming up with our new launches in the third and fourth quarter for the Marathon Next Zone Phase 3. So, overall, we are seeing a good future. We have got good land bank tied up for next 4 to 5 years. Last quarter, we tied up another 14-acre land at Bhandup for mid-segment projects called Neo Homes. And that is also selling very fast, a very good pre-sales numbers which we get in Bhandup across the projects which we have already launched in past. And the same thing which we expect for next 4 to 5 years, where we will be developing this 14-acre land.
Got it. Okay, so sorry, I just want, because it was a long answer, I'm just trying to understand. Let's assume I'm talking about the year as a whole, Mr. Shah. What do you think your numbers could be like if I take into account that it may be long to look at the pre-sales for quarter one alone? How do you envisage FY25 to be like?
So FY25 will be more or less on the same line. We are envisaging the growth in the sales as well as in PAT. Exact number that I have not been able to disclose, but we have a good project pipeline which will give us a growth during this year also. And we are also looking at adding some more projects during this year. We are looking very aggressively on the redevelopment project in Central South Mumbai. And some of those projects are almost in the final phase. So maybe we'll be able to announce in the year end of this year. The project pipeline is very strong. And in my opinion, the segment and the micro market we are working, the sales are really very good.
Okay. Would you need to do any kind of fundraise, Mr. Shah, for the balance of the year in order to execute projects, part one? Part two, is there any consolidation of land banks or any other corporate action that might be coming up in the near term? There are rumors of both happening in FY25 with regards to Marathon.
Yes, so the board has taken an enabling resolution in the last board meeting to raise, near to 500 crore kind of equity raising through QIP route or any other route. Mainly the group is looking at the expansion and adding of new projects is the main purpose. The existing land bank and existing projects are already tied up and fully paid for. So there is no need of a land acquisition for the existing land bank, which is also quite robust to take us for another 5 to 7 years. However, we keep on, adding projects, and for that we may need fundraising. On the second question, which I've been contemplating for quite some time, the group as such, like Marathon Group, has a substantial land bank across MMR region, like almost 50-70 acres in Dombivali, in Bhandup close to 100 acre, in Panvel close to 100 acre, and Thane also. So, there was a suggestion, and there is a committee, board has formed a committee on kind of looking into this aspect. However, there is no, outcome is to come in next couple of months or 1 quarter.
Okay, but could happen in the rest of the year, Mr. Shah? Could happen in FY25, not necessarily the next couple of months, maybe.
I mean, it's very forward-looking thing. When the committee comes up with the whole, proposal, they will take a call on that.
Okay. My final question, Mr. Shah, and which is, you mentioned that FY25 would pretty much be similar to FY24, if I'm not wrong. Would FY26 be a year of growth, you think?
Yeah, I mean, continuously, because what is happening is that we are adding a lot of projects, and the past projects are also, like, for example, the Monte South project at Bhaikala, 12.5 acre land. We have just realized in our books only 1.2 million square feet. 2.8 million square feet are yet to be realized. There are various launches which will be happening in the coming years. We have a large commercial building also, which we are looking at to launch sometime in the next year. So, the pipeline is very robust, and we are very Mumbai specific, where the market is very strong. And I just want to add here, the commercial market has really come back. And what we've been seeing is a very good sales as well as leasing inquiry being floated in the commercial segment in Mumbai. Walk to work and work from home and those type of culture is slowly disappearing. And we've been seeing that many of the companies want now their all employees to come all the days. And that really is driving the commercial segment in Mumbai.
Got it. Okay. We'll leave it at that, Mr. Shah. Thanks so much for taking the time out, and all the best for the quarters ahead.
Thank you.
That's Marathon Group, and Marathon NextGen Realty cracked about 6% yesterday on the pre-sales numbers, but Mayur Shah saying that that is a 1 quarter phenomenon. They'll recovery because for FY25 he believes it'll be a similar year to what FY24 was. FY26 might show some growth. Okay, watch out for Marathon. Important because the stock had a bit of a slam dunk in trade yesterday. Well, take a quick break, but up next we talk about real estate, markets, valuations, autos and more with a very special guest. Manish Sonthalia joins in. Stay tuned. Thanks for being with us. Joining me now is Manish Sonthalia of MK Investment Managers. Manish, great having you as always. Thanks for taking the time out. Manish, a lot of talk, as always, about whether we are stretched, and we've looked stretched for God knows the last 12 to 18 months, and we've still continued to move higher. How are you thinking about the market currently?
Right, Niraj, the conundrum is huge liquidity, and the problem is earnings and valuation. So you got to pick and choose within the entire universe where there is a comfort in terms of earning and valuation, and those stocks will have decent inflows into them. So I was just doing some numbers. India has some 57 sectors, and if you take the mean valuation of each of these 57 sectors, I mean, hardly 10% or 5 or 6 sectors would be at some comfortable valuation zone compared to the last 10 years mean valuation. The rest 50 sectors would be trading at higher than 10-year average mean valuation. So that is the state of things as we speak. And SIP flows, which is basically a smart institutional money, keeps piling on 20,000 odd crores SIP flows. I mean, as long as that continues, you got to pick and choose between the broader markets. India has a long runway to go from here. Obviously, the medium-term outlook is definitely bullish, and even the long-term outlook. But problems in individual sectors will remain for the near term. That is where stock picking will come into play. So that's how things are. Definitely, I think if you don't have some very nasty macro surprises or regulatory or policy surprises on the negative side, all dips will be bought into. I mean, India is turning, as somebody said, from a country of savers to a country of investors. I mean, that's unlikely to be reversed very soon.
Yeah. Probably these things don't get reversed so easily, and maybe for the right reasons, Manish. Investing is better than maybe spending away all of those saving as well. I just wonder though, Manish, you make a very valid point about how just 5 out of 67, if I'm not wrong, I heard you correct.
57.
5 out of 57 sectors trading at average valuations, but the ones which are trading at punchy valuations, some of them are promising or showing a runway for growth which is long as well. So how do you then therefore do bottom fishing as well, even if you are bottom up? Because I'm just saying that a stock will not outrun the sectoral growth in a disproportionate fashion for a long period of time, right? You will go bottom up, but you will still have to have the tailwinds for the theme. Where are those themes where you might be comfortable currently?
So obviously, capital expenditure, railways, defense, infrastructure, these are all important themes in India's context for the next 5-10 years. I mean, the India manufacturing story per se rests on this. So 5 themes which we have also talked about in the past is your consumption, is your financialization of savings, is your energy transition from fossil to renewables, your India manufacturing story, and the digitization, artificial intelligence taking over. So these 5 themes will stand in good stead. Within these 5 themes, one needs to find stocks where you are early in the game, where the market has discovered it and priced it more than perfection, is where the opportunity lies. And mind you, there will be newer companies which will come to the markets every now and then. And because most of the sectors and stocks are well discovered and priced to perfection, given the liquidity flows, I think new companies coming into the markets, you may have a certain advantage in getting into these stocks slightly early.
Point well noted. Okay, the topical point, Manish, I want to start off with a few. Actually, let me first talk about a follow-up to the question that you made. And we have this chart here which speaks about, well, the one thing which will be required at any point of time in a capex cycle, which is power. And let's just pull up this annual power demand in India trend. This is from a report from Kotak Institutional Equities. And as you can see, after a dip in 2021 for obvious reasons, it has trended higher. Even if you argue that 2023 had a large number in terms of growth, the growth in 2024 isn't quite small. And if there were numbers projected ahead, I'm sure those numbers would have looked strong. Manish, it's a theme that has come back with a bang, power. And across the whole ecosystem, generators, distributors, equipment suppliers, financiers. So if you're trying to play capex, is power still looking relevant, or are the valuations too stretched?
Now, I think the point to note out here is that India was underinvested in energy during the demon days and the run up to your COVID. Given the growth that we are having, India really didn't have the energy security that we needed to achieve this sort of a growth. So power is obviously one of that. And within that, I think all aspects of power, and if you are to achieve a 6-7% real GDP growth, I mean, you have a long runway for all segments of power. And within that, it will be your generation, distribution, transmission, energy storage, renewables, and within renewables, solar, wind, cables, conductors, transformers. I mean, you name it. So I think the entire value chain will have a long runway for growth for the next 5-10 years. Now, within that, if you compare where the value is, I would strongly believe that the value lies in the public sector units at the current valuation. So let's take a case of transmission. Many of the private sector counterparts are trading at many times multiples of the largest power transmission company in the PSU space. So you have one such opportunity, or let's say a thermal, or let's say, the guys who are making the equipments. So there's a very big disparity in entire value chain in the private sector and the public sector. Yes, I understand there will be some discount in valuation, but if the growth is out there and bulk of the growth is going to come to a few players because they are so large that you can't ignore them, then obviously there is where the value lies. And you are absolutely correct that, the power, it's not the end of the road as yet. Many of the private sector companies are trading at lofty valuation. They can go through some time correction. Many of the companies are trading at 60, 70p. Probably you would be discounting the next 5 years of earnings. I mean, you can't have a very stretched near-term valuation. Markets will look forward into the future, maybe in FY26 numbers, FY27, but markets can't be looking at FY30 numbers just yet. So the big theme stays, but within the valuation set, I think PSUs have a higher margin of safety in the current sector.
Okay. Speaking of PSUs, Manish, the recent last 3-4 days, one of the sectors that has come back from the brink where valuations might also be good is our energy stocks, and not power, but upstream oil, etc. A lot of people have turned constructive there. Oil prices are not quite buckling down, though not quite flaring either. Any thoughts on oil upstream, or maybe even some of the city gas distributors or oil marketing companies?
So I think this sector is very dependent on policy initiatives and regulations and announcements. So valuations are absolutely comfortable. And mind you, if we talk about the upstream oil companies, they don't get the market realization of the Brent that we see on a day-to-day basis. There is a huge tax element that is out there, and they get a discount. But even after accounting for all of that, I mean, the valuations are extremely comfortable, I would say. And given the high dividend yield on all of these companies, I would think if you're looking for one of the 5 sectors in those 57 sectors is basically energy. And mind you, oil prices have not, petrol and diesel prices have not changed over the last 2 years. Still, these guys are making normal margins. Let's say a GRM of $2-3 and a marketing margin of $4-5 on a blended basis. 5p, 7%, 6% dividend yield, and how can you go wrong? So there is a deep value as far as the energy space is concerned. If we talk about CGD companies, obviously the markets are banking on the fact that natural gas is going to come under GST. If that happens, then, and obviously, the expectation is that maybe in the budget or even after that, you'll have the entire pipeline distribution of natural gas, cost. And the companies obviously are going to benefit because there's an input credit that is going to be allowed. You have the city gas distribution companies where once you actually market the natural gas, well, whatever costs are being paid by the consumers, they can be taken as an input credit. You have the LNG terminal, regasification guys who actually import gas, regasify it and sell it. Obviously, the costs which are included in the regasification will be allowed as an input credit for some of these companies. So I think this sector, the CGT, apart from the deep valuation, some of these names were, let's say, 3-4 years back, have got normalized now to somewhat rational valuation, is now banking on the fact that natural gas comes under GST. And if that happens, then obviously that's going to be a boost for the margins for each of these players in the entire value.
Got it. Okay. Last question, Manish. The sector in focus, autos, with the price cut that M&M had to take, is this the start of, is this pointing towards some demand stress and a start of maybe a prolonged price cut cycle?
The consumer discretionary demand has been soft all across in the first quarter. So autos obviously being a discretionary spend is no exception. Having said that, on a YOY basis, first quarter numbers for the entire auto pack will look fantabulous. But if you were to project the demand going into the future, what was expected, a normalized demand growth of 5% for the four-wheelers, pass cars, and two-wheelers was around 6 to 7% volume growth for FY25, and a muted demand for the HCV space and tractors. What is happening right now, as we read, is that there's an inventory pile-up in the pass cars to the extent of 2 months of inventory. And obviously, once that happens, as we have seen in previous cycles as well, that you have to give discounts, and you are starting to see players start to lower the prices because you have got to clear your inventory. So margin tailwind going out into the future is not going to be there. We expect that the second half of the year, whatever expectation of volume growth is likely to play out. In the interim, there can be some compression in valuations because valuations are rather full given the earnings momentum that we're likely to see. More bullish on two-wheelers, and within the two-wheelers, the premium segment of the motorcycle, which is 125 plus or 150 plus, going up to 350, 400 cc. There, I think the premiumization trend, if you were to look at from a medium-term perspective, looks very, very sound. And that opportunity is going to play out, and you have the likely players, 2 or 3 of them. You have international players like Harley and Triumph also come through. Obviously, looking at the premium end of the motorcycle, starting to look very good as far as the opportunity set is concerned in terms of growth. HCV, you got to wait and watch. Many of the players are alluding to the fact that they see a growth for FY25 as opposed to a flat growth. So, all of these things are so unpredictable, let's say 6 months back, and unfolds to you right in the place. So HCVs, two-wheelers on a positive, pass cars is a wait and watch, hoping that monsoons is going to be good, rural recovery will play out in second half, you'll likely see some growth. In the interim, maybe, underperformer vis-a-vis two-wheelers.
Wow. I think that sums it up so well. Pass cars or passenger cars are a wait and watch. Selective views on two-wheelers, and HCV, where Manish is maybe a bit of an outlier relative to what some of the others are. A lot of other people are negative on HCVs as well. So, but that's the market. It takes both a buyer and a seller for the stock to do what it does. Manish Sontalia, take a moment to thank you for joining in today and giving us your thoughts.
Thank you.
Really appreciate your time.
Thank you.
Well, as we speak, the markets are down and have lost quite a bit of ground from the highs of the day at circa 10:30. But select names, particularly from the auto component space as well, are not doing too badly. So that's a sector you want to watch out. Sona, BLW and a few others have had a decent move in the session today. So keep an eye out for some of those. With that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.
Hello and welcome. This is the F&O Show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space. Well, it's going to be another interesting one to keep an eye on since it is the weekly options expiry for the Nifty 50. Speaking of which, let's take a look at how things are faring there. The Nifty is under pressure at the moment, down around 0.3%, and the Bank Nifty is also, well, down and out. It's not out, pardon me, but it is, down and it's declining by around 0.7% there as well. So we do have weakness there, and a lot of that will be something that we'll be keeping an eye on. But let's also take a look at the big movers on the Nifty 50. Let's see where there is in fact traction. So we have something like a TCS, and we are awaiting earnings from TCS a little later on in the day today. Post-market hours is when we will have earnings there. Coal India, Infosys and ITC. Infosys will be on focus on account of TCS, of course, because a lot of the earnings will perhaps be, rather I should say the TCS will give us a little bit of a trend as to what we can expect for the entire IT pack in general. HDFC Bank, along with ICICI Bank, weighing down on the indices, along with Reliance Industries as well. HDFC Bank and ICICI Bank, of course, will also be weighing down on the Bank Nifty. And that's the reason why we have that weakness, down by as much as 0.6% as far as the Bank Nifty is concerned. If you can also pull up the constituents of the Bank Nifty and see where there is traction. So HDFC Bank, ICICI Bank, as well as Axis Bank, all the big three are under pressure at the moment. We're looking at a 0.5% advance for SBI, but that's not as much momentum. It's not enough to support the Bank Nifty, which is why it's looking at a cut of around 300 odd points at the moment. Let's move on and talk about the futures and options space as well. And specifically with respect to the futures, yesterday was a day where we did see a little bit of unwinding coming through. Today, we're seeing a slight uptick as far as the July futures on the Nifty are concerned, up around 1%, but potentially some shorts being built as far as the Nifty July futures are concerned. What about the Bank Nifty? Let's pull that up as well. And the Bank Nifty also looking at around 2.5% increase in open interest, even as the underlying comes off by around 0.5%. In fact, the Bank Nifty has lost out on the 52,000 mark at the moment, and it's going to be another important level. It's a round number, so that's something that a lot of traders will keep an eye on. Once you lose out on a round number, round numbers usually give you a little bit of support, of course, on the downside, and once that breaks, you start seeing a lot of unwinding as far as puts are concerned, and that perhaps exacerbates that selling pressure coming through as well. We're not seeing tremendous amount of selling, but selling all the same, and there's a higher chance in that case that 52,000 in this this scenario could become a light sort of resistance, so to speak. But I'm gonna say no more and perhaps put all these questions on to our experts for today. But before that, I also want to very quickly take a look at the options market and see how things are faring as far as the Nifty is concerned. It is, of course, the weekly options expiry. We're watching out for 24,200 and thereabout. That's the level that we're keeping an eye on at the moment, because that's where we did see a little bit more of a put writing over the past few days. Notwithstanding yesterday and today, of course, because we did see the Nifty come off. But before that, the put writing had shifted ever so slightly from 24,000 to 24,100, 200, and now today we're just slightly above the mark of 24,200, and hence 24,200 becomes a little bit of an important level to keep an eye on. Of course, on the higher end, we continue to see a lot of traction, a lot of put writing, a lot of call writing written between 24,500 through 24,800. And it does seem like those call writers have strengthened their positions today, given the Nifty has come off as well. So that's the other thing that one may want to keep an eye on. Well, that said, on that note, let's bring in our experts for today. Well, we have Nilesh Jain, Head of VP Technical and Derivatives Research at Centrum Broking, and Brijesh L, Retail Research and IDBI Capital, who's joining us on the show. Good morning to both of you. Thanks for joining in. Nilesh, start with your view on the Nifty. We were seeing some amount of consolidation, but do you think that some weakness is on the charts now?
Morning, Agam. Yes, you have rightly pointed out. I think there will be some more distribution at the high levels, looking at the some amount of profit taking that we saw yesterday as well, and today we are witnessing a follow-up move. One interesting observation on momentum indicators and oscillators front, MACD is giving a fresh sell crossover at the high levels from the overbought territory. And we expect some profit taking from here, not expecting any major crack, but yes, some profit taking and consolidation is something that we are expecting at current level. So from today's weekly expiry point of view, the range looks like 24,150 to 24,350. That can be 200-point expiry range for the Nifty. Narrow range could be somewhere around 24,200. We might see the weekly expiry. But from a next 3-4 days point of view, I think Nifty is heading towards its 21-day moving average that is placed at 23,900. So it may test 24,000 to 23,900 going forward. At current level, I think it is better to stay light and wait for some meaningful correction towards 24,000. And probably that level could be a good entry point as far as long position is concerned. But yes, at high levels, it is better to stay light.
Better to stay light and initiate longs when the Nifty starts hovering around 24,000. That's the word coming in from Nilesh. Brijesh, what about you? How are you reading these markers as far as the Nifty specifically is concerned?
Hi, morning. So my view on the index is more of a range bound. I do believe that there has been some selling pressure at the current level. But as long as 24,200 level is respected, even today's trading session, and let's take today being a weekly expiry. If today 24,200 is respected, and for the first till the 12:30, 1 o'clock time frame, I sense there can be some intraday bounce, mainly because I'm seeing some strength in stocks like some of the banking stocks are suggesting little bit of strength. Auto pack is showing strength. IT is showing strength. So basically, this can be the individual stock specific trade, but then that I believe Nifty might hold 24,200. So this would be again a range bound kind of a view, and the aggressive move would start when Nifty starts trading about 24,300. So, but right now, whatever is the 70, 80 points correction we are seeing, I have a sense that this might get recovered. Not market might close on a flat note. So with some confirmation, I think we should be trading for intraday long bets with the stop loss of 24,200.
Okay, so an intraday long bet, but based on the fact that we could potentially see the Nifty testing and maybe taking a little bit of support around 24,200. That's the word coming in as far as the Nifty is concerned. Let's shift focus to the Bank Nifty now. And before I go across to my to our experts, once again want to pull up the constituents of the Bank Nifty specifically to see where there is in fact support. In terms of the futures and the way things are panning out there. So if we can quickly pull that list up as must. Okay, maybe we can get back to it eventually. But Brijesh was mentioning, there are a handful of counters in the banking index which are in general from a trend perspective looking slightly stronger, and which is why there is a little bit of support as far as the banking names providing that to the Nifty go. That said, at least in today's day of trade, there is some amount of pressure on both these key indices. But speaking of, Nilesh, I come to you on the Bank Nifty. How are you placed here?
Comparatively, Bank Nifty is looking slightly on a weaker side. And if you look at from past 3 to 4 consecutive sessions, Bank Nifty has been underperforming compared to the Nifty index. And today, in fact, yesterday on the back of weekly expiry, somehow it defended 52,000 level in the spot. But today it has broken out that crucial support zone. And it looks like it is heading towards 51,600 to 51,400 on the lower side. So comparatively, Bank Nifty is still looking weaker. And if at all we see any pullback that might get sold into, so any pullback towards 52,200 to 52,500, that's the immediate supply zone for the Bank Nifty. Now, the major concern is from HDFC Bank, where we have seen a formation of a low top and low bottom. And at current level as well, it looks like HDFC Bank is heading towards 1580 to 1560. So on the back of that, we expect further some more selling pressure in the Bank Nifty. So better to avoid taking any contra bet at current level. And if at all it comes in the range of 51,600 to 51,400, that could be a good entry point from a pullback point of view. But as of now, it is better to stay away taking any contra bet.
Okay, there you have. That's the view on the Bank Nifty. Brijesh, your assessment here on the Bank Nifty?
Yeah, see, I believe there has been a sell-off in the Bank Nifty, and today for the very first time 52,000 level has been broken. So definitely the support level has been broken. So that is one way to look at the from the Bank Nifty index point of view. But I'm more looking from the stock specific point of view. If you look the formation, clearly the derivative data for the stocks like SBI, Federal Bank, Axis, and ICICI Bank, there has been a good amount of long build-ups from the weekly perspective. So I believe somewhere these stocks are going to give strength to the Bank Nifty. That is one of the reasons why I believe the markets for like Bank Nifty can find some supports at 52,000. So, though right now it is broken, but my sense is that during the closing day or something like that, we should be recovering above 52,000. ICICI Bank, the data is quite extremely positive. I believe ICICI Bank can easily go back to 1260, 1270 levels. So that is one of the reasons. And ICICI Bank, I think it holds some 23% kind of a weightage in Bank Nifty. More with the stock specific trade, I sense Bank Nifty can see bounce. So I may go wrong if today the Bank Nifty closes below 52,000 level, then I might need to change the view. But right now I sense that whatever this fall is, we are seeing this fall, might get some support, and maybe the second half of the day there can be some recovery.
All right. Well, that's as far as the Bank Nifty is concerned. So, a little bit of slight contrast between both our experts, but both making very, very valid points at the moment when it comes to the Bank Nifty going in. And it's something that, we need to take notice of. But from there on now, let's shift focus to stocks. And, naturally, we'll talk about all the stocks which are actually seeing an increase in open interest. So we will bring that up. But want to perhaps talk about a handful of names that are on my radar. So I'm going to actually very quickly take you through some of the key movers as far as the F&O stocks are concerned. We actually do have a slight bit of an advance for Tata Motors. That's the one which stands out. Along with that, Trent, naturally. Trent is an interesting one because off late, it's been a slow and steady up move, but over the last 3 to 4 sessions, it's also moved sideways. It's still trading near its life high, so that's the interesting bit. And any move upwards, a sharp surge upwards with good volumes could potentially mean the resumption of that up move. That said, if the volumes do in fact, will start to dissipate, then you never know. It could perhaps stay in this consolidating range, and potentially some traders may also look to book profits. So that's the reason why a Trent looked interesting to me. Voltas is the other one. It's only marginally in the green. We haven't seen a substantial up move, but in terms of losers, I reckon there will be plenty more to keep an eye on. So Sun Pharma and Lupin, along with Cipla, are under pressure this morning. And besides that, we're looking at some amount of declines as far as UBL is concerned. UBL is also down around 1.3%. You guys will notice that all these counters, while they are weak, they aren't substantially weak. So, we're looking at cuts of around 1.5%, 2%, no more than that. So it's not like there's intense selling pressure at the moment. Perhaps just some brakes being applied at the moment, given the kind of traction that we've seen in markets in general abroad. That said, let's take a look at what our experts have to say in terms of stocks which are on their radar. Nilesh, I come to you. What's looking interesting to you at the moment?
So Agam, I have a couple of buy recommendations. First of all, ITC, this particular counter, recently we have seen a good momentum with a good breakout. So technically, the stock has turned positive given the kind of a breakout that we have seen, as well as even if you look at today, we have witnessed good OI buildup of close to 2%. So long buildup is happening. Yesterday was a pause in the trend, but today it has once again regained the momentum. I think from here, it may move in the range of 470 to 480. So these are the two targets on the upside for the future. So 446 should be the stop loss. Apart from that, the other stock is from financial NBFC space, that is M&M Finance. This particular counter is also looking positive. From past couple of weeks, it has been in the tight range. It was trading in a falling channel. Now today, it has given a good breakout from the same, and good OI buildup is happening here as well. So M&M Finance is looking positive. One can keep a stop loss below 295 and go long for immediate target of 308 followed by 330.
Okay, that's a couple of calls coming in from Nilesh. Brijesh, stocks on your radar this morning?
So one of the picks from my end was also the M&M Finance. So I do believe there is a good amount of long build-up, and from the technical perspective also, there's a good formation. So my understanding is like one should go along with the stop loss of 295 for the target of 315. So that's the first trade. And second position which we are keeping a watch on is the Tata Motors. So Tata Motors, if you see at the level of thousands, the call writers have exited their short position. And from yesterday to till now, there has been fresh longs have been added in Tata Motors. So I have a sense that Tata Motors can see some 30-40 points kind of a move during this expiry. So somebody wants to take this expiry like a monthly expiry view. So Tata Motors can be a good bet at the current price with a stop loss of 1008 for the target of 1055.
Okay, so interesting calls coming in. Of course, the common call between them is M&M Finance, which of course is something that stands out. Among stocks that I'd potentially want to take up is ONGC. Now, ONGC is, of course, again, at an interesting level right now. The stock, of course, has advanced. Today, of course, it's showing a very quiet moves. But, we were noticing the open interest on the 300 call for ONGC. And there was substantial, calls being written out there. The question is that if ONGC continues to trade at these levels at around 296, 298 and thereabout, there is a chance that you will start seeing a lot of these traders unwind that 300 call, the short call. The question then is, does that mean that ONGC could potentially see a further up move? Based on that, we do remember that ONGC's had a reasonable good run of late. So on the flip side, the question then is that can we expect some amount of profit taking here? Brijesh, let me come to you on ONGC. Your assessment, how would you read into factors here?
Yeah, see, from a technical point of view, there has been a range breakout at a level of 280. So definitely on the technical ground, I'm convinced that this 300 level will be taken out. Now, if you filter it from the with the reference to the option data, once this 300 strike price, the call writers they cut down the short positions, then easily we can be looking for 310. And after 310, it would be 315. So this would be the next leg of upside which you can expect in the ONGC. So I'm pretty confident that once 300 is taken out, we'll be heading for 310, 315 on the higher side. So it remains a very good, it's a long trade setup.
Okay. The other stock that I wanted to address actually was a potential for, mean reversion, and I want to talk about Polycab here. What's happening in Polycab is that it's actually taken a severe knock. It was trading at around 7,300 and thereabout about a couple of weeks ago. Since then, it has come off quite substantially. Do remember that there was a very large block in the middle, and after that, it has seen a gradual decline coming through. Today is perhaps the first day that we've seen a green candle. This is following about 5 or 6 sessions. The question really is that, is this a time where this downtrend gets arrested, or is it too early to call that end of the trend? So, Nilesh, this question is for you. Levels that you want to keep an eye on, whether you would go long, short, or perhaps avoid Polycab. And under those circumstances, what levels would you keep an eye on?
Well, Agam, it's too early to call it as a bottom because the trend is on a negative side, and today is the first day of a reversal. So we don't really know whether this is a sustainable move. So I would rather wait for a reversal above 6,600 in the spot, and if that happens, then probably that will be the first sign of a reversal, and I would say a bottoming out. So I would rather wait for a breakout over 6,600 to go long. And at current level, if somebody is already holding the long position, can keep a stop loss below 6,300. That's the recent swing low that this particular counter has made. So 6,300 should be the stop loss. And if somebody wants to take a contra bet, I think the stop loss is still remain the same at 6,300. And if it breaches 6,600, then I expect that it is likely to make an attempt to fill the gap that we saw on 28th of June. And the gap area is in the zone of 6,800 to 6,850, and that is likely to get filled post breakout above 6,600. So at present level, I would rather wait for some more confirmation.
Okay, and the final stock that I want to address is Trent. Not unlike ONGC, what we've seen in the case of Trent as well is a steady up move and now sideways movement over the last 3 to 4 sessions. But this has been on the radar of a lot of those traders who actually trade momentum. And Trent clearly has been one of those stocks which has actually given you great returns over the last 12 months, 6 months, 3 months, what have you. And the question really is that at the moment, do you think that you'd want to go ahead and perhaps buy, and if you want to initiate fresh long positions, what is your risk level at which you would want to move out? What is your stop loss? So Nilesh, I'm coming back to you on Trent. Your view here.
So this particular counter has been in a secular uptrend, and it is constantly showing strength, trading at all-time high levels. So undertone continues to remain on a positive side. So first of all, if somebody is looking to make a fresh entry, I would rather wait for some meaningful correction towards 5,400 or maybe below that. And if somebody is already holding the long position, should keep a stop loss below 5,400. The stock still has a potential to move towards 5,800 to 6,000. So given the kind of run-up that we have seen recently, there could be possibility of some consolidation. I'm not expecting any major correction, but yes, consolidation could be seen going forward from here. So I would wait for some dip towards 5400 to make a fresh entry. But yes, this stock still has the potential to test 6,000 kind of a level from a short-term point of view.
Okay, there you have it. That's the view on Trent. And on that note, well, we conclude this segment of the F&O show, thanking both our experts for joining us and taking us through their views in the markets and, of course, handing us a couple of trading ideas as well. With that, we slip into a short break, and on the other side, we continue with all the market action from the commodity space. Back in just a bit. Welcome back to the F&O show. We put the spotlight on the commodity space, and for that, we are now in conversation with Dinesh Somani, co-founder of Pro IntelliTrade Services. Dinesh, good morning. Thanks so much for joining in. Well, let's start with your view on crude in general. We've seen some amount of volatility. How are you looking at trade there?
Yeah, good morning, sir. I see crude in the range-bound activity, downside 66,600, upside 69.20. Now, these are the range where the market is trading from last few days. But I see a downside is restricted and the trend is up. Any fall around to 68.85 should be a good buying level. For upside, 69, 60 and 70.20 with the stop loss below 68.15.
So that's as far as crude's concerned. Let's move on and talk about a handful of other, commodities as well. Also want a view on perhaps gold and silver, Dinesh. How are you looking at trends here? What are the factors, fundamental and technical, that could potentially move both these precious metals?
Yeah, definitely. We heard the Fed statement yesterday. They said that they won't wait for the inflation to come down to 2%. And that was the dovish comment from the Fed chairman. And we expect prices to cut within the year end, probably in September and also in December, and that could pull the prices of gold to higher levels. Currently, gold trading around 72, 850, 900. We may take in for a dip for 72, 750, 800, where buying would emerge. We'll place a target at 73, 300 and stop loss below 72, 570. The market looks bullish both in gold and silver. Silver trading levels around 93, 400 is a good buy level. And upside is 95,000 in a span of 3 to 4 days, keeping stop loss below 92, 650.
Okay, so that's as far as gold and silver are concerned. Of course, among many others, we have a lot of traction in your base metals. Case in point, copper. Dinesh, at the moment, your view on copper?
Yeah, so prices rallied almost from the price of downside 700 to 945. It took a corrective phase of 50% retracement till 835 levels and then move up to 880 levels. Now the corrective phase is over. The flat pattern created on a daily basis, I think it would give a breakout in a day or two. Anything around 870, 71 should be a good buying level. Upside positional target is 896, 862 should be the stop loss. I mean, I think that base metals are going to show a sharp recovery in the days to come.
And Dinesh, what's looking good to you in terms of trades when it comes to some of your agri-commodities?
As far as agri-commodities is concerned, there is a good demand for castor oil in spot market and also in the export demand. I think castor seed, anything around the August contract, 6060 is a good buying level. 6340 should be the target level and 6010 should be the stop loss. On the other hand, cotton seed oil cake is also looking fantastic on the chart. The August contract is finding support at 3040. Upside is 3085, 3115, and stop loss should be placed below 3015. Both these counters are looking excellent, and investment could be done for the next 4 to 5 days for them.
All right, Dinesh, we leave it at that. Thank you so much for joining us and taking us through your views on the commodity space. On that note, we are also out of time on this edition of the F&O show. Lost my lineup on the other side. Keep watching NDTV Profit.
Welcome to NDTV Profit. My name is Rucha Somaya and today we are going to discuss something about Optimus Infracom. Now, today we have with us Mr. Ashok Gupta, the chairman of Optimus Infracom. Welcome to the show, sir, and thank you for joining us.
Thank you, madam.
Let me tell you about...
Pleasure.
Sure, sir. So let me move ahead with a brief explanation about the company. So the company is primarily engaged into manufacturing and marketing of mobile and telecom products in India. But the company has recently launched a range of drones in the agriculture and mapping category. So can you tell us something more about this, this particular segment that you have recently launched?
In fact, agri-drones are the need of as per our Honorable Prime Minister vision to make farmers' life more prosperous and to increase the yield. This is one of the most required thing as of now. You can see since last so many years, farmers are trying to get more yield, more prosperity, and technology in agriculture area by drones are the most required thing as of now, which can help the country, which can help farmers to improve their yield, and which will be in terms benefit their prosperity. So seeing this immense opportunity and to align with the Honorable Prime Minister vision, we enter into this area, and now just 2 days back, we launched our first agri drones, which is of a 10-liter capacity, which can do 1 acre of spray in just 7 minutes. Apart from that, India is a very price sensitive market. To keep that affordability part in our mind, we launched a very aggressive price at 2.25 lakh as a starting price, and most importantly, 65% of the component are in-house or through our ancillary partners. Why 65% local parts? Kindly appreciate, localization is the key for any component which can make success and price sensitive. But more importantly, after sales service will be only possible if we have local components to support the after sales service. So this was the basic reason that we enter aggressively in this field, and we hope that sooner or later we can embark to a new journey to support the Honorable Prime Minister Modi's vision to make farmers' life comfortable, prosperous, and increase the yield.
That's so. As you rightly mentioned, 2.25 lakh is the starting price for the components. I get that. So, what kind of margin are you looking forward coming from this kind of drone?
You see, when you are talking about margin, to be very specifically, we are not looking just sales. We want to use drone as a service part. We want to go and launch in 2025 5,000 drones on ground, which can support farmers for spraying nano urea, pesticide, precision technology and farming, and then crop insurance as well. So sales will be one part, but our focus will be to start with in 2025, the drone as a service in agri area primarily.
So you're likely to convert this into revenue by the end of 2025?
Starting 2025 January, there are two crops, Rabi and Kharif. So we'll start deploying 2025 January. Until the end of 2025, we will be in position to deploy 5,000 drones on ground with 1,000 drones for backup. Because as I told you, after sales service is most critical, right? To support that after sales service, we can deploy 1,000 additional drones with this concept.
So for this, you had also mentioned investing around 140 crore rupees in the project. So has that already been done, and are we looking forward to some kind of margin dilution going ahead till the drones start getting converted into revenue?
So ma'am, to be precisely, we will start manufacturing drones by end of Q4 so that we can deploy drones in Q1 2025. So the approximate investment in 6,000 drones plus infrastructure and other things will be around 140 crore rupees. And we will quite sure that in that next financial year, we will be able to generate around 600 to 900 crore based on crop in which we will do, like floriculture, horticulture, and rice, and other things. So this is our plan, and we are very much sure that we will achieve these things by our in-house expertise of R&D, manufacturing, and distribution capabilities, which we built over last 30 years.
Right, so got that. So just what kind of percentage of revenue will this drone segment be amongst the manufacturing? I see that it's around 49% of your revenue in the financial year 23 and 61% of revenue in FY24. So what kind of percentage is this drone category possibly from the total revenue?
So you see, OIL is a listed company. So we have different verticals. We have 3 PLIs in mobile, telecom, and IT hardware. So these verticals will do separately working. The OUS, Optimus Unmanned System, is a subsidiary of Optimus Infracom Limited. As of now, what revenue and what investment I am talking about, it is purely on the unmanned system with this service model, madam.
Okay, right, sir. So talking more about the segmental business, I see that you have telecommunications and manufacturing split between 38 to 62%. While meanwhile, in the last financial year, it was almost around 50%. So do you plan to increasingly get revenue from the manufacturing segment and gradually, decrease revenue from the original telecommunications segment? Is that kind of split that you're looking forward going ahead?
So exactly, you are right. Every segment is a focus segment for us. Like IT hardware, which PLI will start just now from April 2024. We are very strong working in telecom space with some global customers and for local customers. So each and every segment will grow separately in this area year and going forward. So I cannot give you the breakup how we will grow in different areas. But as of now, my focus, apart from EMS, from telecom or IT hardware, my focus is to support agri drone service by our expertise in this area. And we will do certainly much better revenues from those areas because that is a service area. Sales is different, service is different.
Sure, sir. So, as I read in the 4Q presentation, you also mentioned that you received first order for the quadcopter in the fourth quarter. So, can you just tell us the deal size or the kind of margin that you are expecting to earn from this order?
So, you see, we just gave some 4 surveillance drone. So, some northeast state, and they tried that. To be very honest, as of now, we are not looking higher margin. As I said, when we will focus on Make in India, our price will be very competitive. When I said defense area, almost all the drones and maximum electronic parts are made in our factory. I know we can compete with our capacity and capabilities of electronic manufacturing space. We will be able to provide very aggressive pricing, but surely quality will be there, no compromise.
Sure, sir, got that. So what kind of drone deals in particular can be in your pipeline, if you can tell us, if not quantification, the percentage of drone deals or any plans for the drone segment going ahead?
So drone has right now majorly 3 segments. Actual in every part of our life is a country life, whether disaster management, whether mapping, whether defense, whether logistic, whether agriculture. There are so many verticals for which drone can be helpful. So our focus is as of now, 1, agri drone service, and secondly, we are going for some RFQ for defense already in pipeline, where we are going to shortly give trials, and if they approve that, we are ready to supply them quantities as per their requirements. So logistic policies is not ready as of now, but surely when the policy will be there, slight modification in agri drones, like we can use them for logistic purpose with specific softwares.
That might reduce our expenditure and aid margins maybe going ahead. Is that correct, if I've got that correct?
Pardon?
That might increase your margins going ahead if this thing comes into place, if I've got it correct.
Actually, to be very honest, margin is based on economy of scale and localization, right? I am sure with drone industry, EMS industry has a different margin percentage, but drones with R&D in-house, localization in-house, and distribution in-house will certain give us more margin and profitability in coming time sooner.
Sure, sir. Thanks for that wonderful insight that you've given us on the company and the drone segment as well. So that is what we had from Ashok Gupta, Mr. Ashok Gupta, the chairman of Optimus Infracom, and thank you for joining us on the show, sir.
Welcome back. You're tuned into the Small and Mid Cap Show here on NDTV Profit. I'm Harsh Saita. With me is Anushi Vakharia. And, quick check on where we are, where the benchmark is concerned. We're seeing a bit of pressure on the Nifty 50, largely led by the private sector banks. So we're 1/3% or so down in terms of where the Nifty 50 is at. Sensex down also by similar quantum, around 1/3%. Let's pull up some of the sectoral heat map if we can, just in terms of what sectors are performing and what is not. And within that, what you'll largely see is realty, pharma and finance is where the pressure is really coming from. Those are the three segments. And within finance also, it's private sector banks, which is where a bulk of the pressure is coming from. PSU is doing well again in trade today. You're seeing good traction in energy, media as well as auto. So, after yesterday's bit of pressure with regard to where auto is concerned, we're seeing good traction there. PSU banks doing well, or rather flattish compared to how the Fin Nifty as well as the Bank Nifty is doing. So That pocket also doing fairly well. IT services absolutely flat after a muted day yesterday. So not bad, at least where that sector is concerned either. Also earnings focus where Tata Elxsi and TCS is concerned. And therefore, the Nifty IT will definitely be in focus today. Let's also pull up the key contributors in trade, and that's what the texture will also indicate in terms of the Nifty 50 contributors. We're seeing some of the FMCG as well as utility names, Coal India, ITC doing well. ONGC also within the PSU basket and Tata Motors. So it's a mixed bag where the gainer contributors are concerned. And in terms of the losers, well, clearly private sector banks, Axis, ICICI, HDFC making it to the top 4, along with Bharti Airtel, even Reliance, slightly down around 0.25% or thereabouts, and that kind of dragging the index as well. So that's where all of the pain is really coming from. In terms of some of the buzzers in trade, if we can start pulling up, Ahluwalia Contracts just won a new order. The stock is up roughly 5.5%. You have something like a GE Power doing well, HPL Electric. Well, this one is going electric today. In fact, up almost 17% now, and 3,000 odd crore in terms of market cap and 2,000 crore order win. So really strong. In terms of some of the others, Kalpataru Projects also won an order up 2 odd %. We are seeing good traction in PTC Industries. We have a fundraise coming in on the 13th of July, at least board meeting for that fundraise. Now, let's pull up something like a Titagarh Rail, because that one in focus given the budget theme likely to start to play out. If we can have a chart with regard to the 3, 6, 12-month kind of returns that Titagarh has posted, just for context, the kind of returns have been astronomical, extremely solid returns over the last 12 odd months. And you can see that in your graph. A bulk of the last 5-year returns have come in the last 12 months.